All right, folks, welcome to the market close. Today is a very important market close. We are ending off the, I guess, very pivotal and significant companies that are announcing their earnings. Meta, Amazon, and Apple. We had Microsoft and Google already. We still have the NVIDIAs of the world. We still have the Robinhoods of the world, the PayPals of the world. Still a lot of important companies. But today, we get three companies back to back to back. We're going to be listening to Meta from 4:30 to 5:30, then Amazon from 5:30 to 6:30. So we're going to be here for a couple hours, but probably like almost 3 hours, maybe 3.5 hours. So get ready, get excited, get some food. And today's going to be a big day. Today's going to be a very, very big day. It is going to determine, I believe, the future of at least the next 2 months. Because if these companies do not perform, if these numbers are not real, it's going to be very difficult for the market to be able to create multiple expansion. And it's going to be really hard for, even if interest rates come down, for us to justify expanding multiples on companies that have gone up 70% in the past 7-8 months. So we've got a lot to talk about and a lot to discuss on today's market open. Valero, Ty Gordon, Jonah Anderson, Niels, Mr. Seymour Duck, Tom Brady, Dale, Monty, Mark LeBlanc, Niels, Midwest, Imnop, Bay Ray, what's up? John, FUCK says, how nervous are you 1 to 10? I don't own any of these stocks, so I'm not super nervous. I did buy the Google dip today. I DCA'd into those spreads that I got. So I got it at $980, and my average is $991, came down to $989. Right now the spread's at like $960 or something. So 3 days ago it was at $13. So I think it's a meaningful decline. Put about $1,000 into Google, and I'm done. That was my DCAing. So I'm pretty much done, ready to go. Apple, Amazon, and Meta now. I don't own these stocks, but I am excited to see what they say. I don't know how much impact they're going to have on Microsoft or Google, but if they really crap the bed, it's not going to be a fun earning. So we'll see what ends up happening for this one. Earnings Super Bowl week ended after this market close. Yeah, this is going to be a pretty big earnings Super Bowl. Artist here, thank you for the $10 super chat. I know we've moved past this, but I think Zuckerberg hearing was a public lynching and a struggle session by people who don't get how hard it is to manage social interactions at scale. Okay, bye. It'd be interesting. He's talking about Senator Cruz basically grilling him on all of the algorithmic issues that are going on with Facebook and children's safety. And, at the end of the day, I think there's two perspectives. Either you agree that it's all Facebook's fault and they need to fix the algorithms, or you see the fact that there's 3 billion people posting 17 trillion times a second. I'm being hyperbolic here, but you get the point. And it's very hard to manage that at scale. I think there's responsibility on both sides, but nonetheless, I don't think he's going to talk about it on this earnings call. I think Zucks did his stupid apology yesterday that he was forced to do, and now he's going into ruthless killer mode for earnings because he wants this stock to get even higher, even though he's sold out about $600 million worth of it in the past couple of weeks. So we are going to see what happens. Artist here, thank you so much for the $10 super chat. Okay, this is going to be a long earnings call, 3 hours at least. So we're going to do some DD, folks. We got a Celsius. In fact, we have 3 flavors. I'm going to try one every single day. I'm not going to try all 3 at once because then I would be wasting them. Unless they all 3 suck, then I would probably not drink it anyway. But we got Tropical Vibe, Pineapple, Sparkling Starfruit Pineapple. And we got some ice to make it cold. So let's get into it. I mean, let's see. I'm not sold on Celsius yet. I like the numbers, and I'm getting closer to understanding their market opportunity. But let's actually see if this thing tastes good. 10 calories, 0 sugars, right? Are there any sugars in this? Why isn't it showing the sugar? I can't see the sugar. They're vitamin C, 0 fat, 0 proteins, total carbohydrates, 0. For some reason, I guess it's always, 0 sugar. There, it's right at the top. So they want to convince you 0 sugar right there. All right, let's do it. Here we go. Let's see. The smell is interesting. Let's do this right here. We got to be energized for the next 3 hours. So let's see if this helps. All right, here we go. Tropical Vibe. This is the first time I've drank this in like a year on Celsius. Let's take a sip. It tastes like diet pineapple soda. I forgot to say 1 bite. Everyone knows the rules. I forgot to say that. How much is 1 can? It was $2 at my local grocery store. $2, which is actually cheap compared to the other ones. Yeah, it's not like that special to me. I don't know. Is this some, I don't know, dude. When I drink a Red Bull or I drink a Monster, there's a certain type of feeling. It's only a feeling that you can have when you drink it. Like when I drink a Red Bull and a Monster, I don't think I'm drinking like a soda. I think I'm drinking like an energy drink. This feels like pineapple soda. It just, it's, now obviously people like this shit. That's why it's growing so much, but it just tastes like diet pineapple soda. I don't really taste the energy. Like in a Red Bull and Monster, I taste the energy for some reason. I don't know. Okay, well, that's there, and we will be drinking it throughout this earnings call and keep going from here. All right, so we've got earnings in 9 minutes. This is going to be a very complex mission. I've got a lot of tabs and a lot of screens open so we can get the data as soon as we get it. Google right now, 142. Verizon, 42.48. Let's look at the actual numbers for the market before we get into it. Let's pull up a Webull right here. So we've got Amazon at, oh, by the way, S&P is up today. It was at 482. Right now it's at 488. So market went up a little bit. Amazon 158 up 2.32%. Apple is 186 up 1%, and Meta's at 395. Meta's at 394.77. Tim Cook released a interview with Vanity Fair today with him wearing the Vision Pro, and it was interesting. I read a little bit of it, and then I got bored because I don't know, dude. It's just like, it wasn't that exciting to me. I mean, I don't know. They're trying to really hype up this Vision Pro. Let's see what they're going to be able to say as we go into this earnings call, and we'll get the numbers soon. And I don't know if they're going to give any numbers about Vision Pro, but they'll probably give a little bit of guidance, hopefully, on what's going on with Vision Pro. And we'll see what happens. But these stocks are green for the day. They're not red, so they're going into a print that is going to be green, or at least they're green right before they're going into the print. And so we're going to see if any of the numbers make it weird or if any of the numbers make it super exciting for what these companies look like. Let's get a couple updates on Meta and Apple, and then we will keep going from there. So here's an update on Meta, and then we'll talk about Apple, and then we'll get through some earnings numbers as well. Here we go.
Dallas Clockwise Capital Partner and portfolio manager. To and truly overweight is based on how predictable is the revenue picture and the earnings outlook. And on top of that, how much optionality is priced in or not priced into these stocks. And we think among the 7, only Amazon, Meta, and Microsoft have that predictability as well as optionality. And the other ones, we have question marks on, like as Steve was reporting, what happens with Apple shipments, iPhone shipments this year, Tesla kind of throwing their hands up in the air on unit sales for the year. So there's more questions than answers on the 4. So we're leaning into those 3.
Yeah, and you heard Steve talking about Apple, and I'm not picking on him again. Everyone loves their iPhone. What I'm saying is that it feels like Apple is a phone company. They've got augmented reality. It's going to be cool, but that's got to be a niche product. Of course, the MacBook, they're great, but you buy one, it lasts hopefully 5 to 7 years. And the iCloud services business. In your view, what is the proper way to value Apple? Just pure phone sales?
I mean, we do look at it on some of the parts basis, but ultimately, I think that investors will just predominantly value this on a PE basis.
I agree. And that PE right now is very high for the lack of growth that we're getting from Apple. So that's going to be really interesting to see what can they do to get these numbers to come out to be better. Here are Facebook's numbers. This is the numbers we're expecting for Facebook. Revenue of $39 billion. That's up 21% year over year. EPS up 24% year over year, $4.91. Daily average users, the street wants to see 3.1 billion daily average users. I mean, it's just absolutely incredible what we're going to see for Facebook if they can end up hitting these numbers. So that's what we're looking at on Facebook: 39 billion, $4.91, and daily average users of 3.1 billion. In terms of Amazon, what we're looking for is revenue of 166 billion. We are looking for, which is up for 11%, EPS of 78 cents. That's up 356 cents, 356%. And then AWS revenue of 24.2 billion. Amazon's going to be the most interesting to me because Amazon has run up a lot in the past 3 months. And if CapEx doesn't meaningfully come down, that PE is going to be high. If CapEx comes down, that PE gets lower. And if growth is at least moderate, 12 to 13%, same thing similar to Google, then I think the stock's going to do well. But I don't know, because there is a world in which CapEx comes down. So they have all these input costs that have fundamentally started to come down, which is just the problem. In Q4 2022, they were exploding with these costs because they were just coming off the pandemic where they invested all their factories. That's going to come down. Great. But what if AWS cloud growth, particularly as an AI play, does not guide for significant growth like the Azures of the world? What if advertising is kind of What if it's not guiding to be really well? I mean, these are the things I'm thinking about as Amazon hits $160. Their all-time high is 180. Does the market really give them 165, 170, 163? Like, does the market really give them that expansion? I don't know. And if they do give it to them, do they take it away? I mean, Microsoft could barely hold their multiple. Google obviously didn't hold their multiple. So I don't know. A lot of people are bullish on Amazon and Meta. I don't know, given these stocks are at near all-time highs, Meta being at all-time high, what the street's going to say. But maybe they just give the right guidance they need to give, and this thing goes up really well. And it's going to be good. Jamie says, hi, Amit. Have you seen the new AI shopping assistant Amazon just revealed? It's called Rufus. Yeah, I just heard about that news. That came out like 20 minutes ago. I'll try to pull up a press release on that. I don't know how amazing that's going to be, but it is a thing that Amazon is coming out with. Again, they're going to try to implement a lot of random AI stuff into their company. At the end of the day, it's not going to affect their numbers today. Right now, the numbers is really what matters, but we'll take a look at that in a second. In terms of Apple, what we're expecting is $118 billion in revenue. How crazy is it that we live in a time where a company can put up $118 billion? I mean, it's just insane. Absolutely incredible. Up about 1% year over year. So that would be the growth. Again, Apple at a 30 PE or 27 right now. EPS of $2.11. That's up 12% year over year. So in about 3 minutes, we're going to see, and I think these guys do it at like 4:05. So it might take a couple minutes after that. But these guys are going to have to justify these numbers with this type of growth and be able for it to actually make sense. Because as of now, I think a lot of people are saying, hey, maybe this doesn't make sense. All right, here's the Amazon generative AI shopping assistant called Rufus. So it's a chatbot where, this is actually kind of cool. You can say, what are the differences between trail and road running shoes? Oh, this is actually genius. This makes so much sense because when I'm asking a question about anything, if Amazon can just say, hey, here's your answer. By the way, buy this shit. I mean, it actually makes my life a lot easier. If I'm like, hey, I need really good running shoes that I don't want to pay $90 for. Can you give me something that's cheap? It's like basically instead of filtering a search query, you're just using natural language to just either type it or say it. And then it gives you the answer. This is actually one of their best ways of incorporating LLMs, in my opinion. This is actually really cool. And then I would imagine there's some advertising that can be done in this spot as well, which is just more inventory for them to be able to sell ads. That's actually really cool. I like it. I don't think it's that bad. Artur says, do you think we will get a recession if we see very bad earnings and then indicating weak consumer? Probably, especially if we have unemployment that goes higher, but we do not see unemployment going higher. We actually got a really good jobs report today, even though it ticked up jobless claims, but not unemployment writ large. But there's no signs of unemployment getting to anywhere near 4% yet. So the consumer, for it to get weak, remember, we have to have people not having jobs. So far, that syllogism hasn't played out. So even if we have weak earnings, I don't know if that's a sign of the consumer being weak, rather than a sign of just these companies not living up to crazy expectations. We'll see when we get these numbers. So I don't think we're in that territory yet where we should be really scared of recession. But I definitely think we're in the territory of some stocks being in a bubble. SMCI, SMCI is at 583. Dude, I have not looked at the stock since the morning. Oh my God. It's so big. That's a big green candle. Tell me that's crazy. Who the fuck is buying SMCI at 550, dude? All right, it's 4 p.m. February 1st. The stock market is now closed. All right, folks, let's get ready. Lock in for the next 3 hours. We got Apple, we got Amazon, we got Meta. It is go time to see if this economy is going to be okay. Let's pull up Amazon numbers and let's just leave it there. I've got a bunch of screens open and I'm pulling up all these websites and getting this stuff ready. I still don't get how SMCI is almost at $600. Like, they have hardware margins. They don't have software margins. Their margins are like 10 to 15%. I don't know who the hell is buying this thing up 80% in a month. I don't get it. But all right, Amazon IR, let's pull them up. They're probably going to take like 5 minutes to report. Meta IR. And then we got Apple IR. Here we go. Amit, you said the same thing with Nvidia at 525. Yeah, I did say buying Nvidia at 525 is crazy. Now it's at 618. And I'm not going to predict Nvidia's coming back down to 525 at this point because Nvidia's PE is only 50 and the growth is still amazing. So I don't know, but SMCI is different, dude. It's not a software. Nvidia has like 70-80% gross margins. SMCI doesn't. And SMCI's growth is great, but I don't know if it warrants a 100% gain in a month. The stock was $318 on January 1st. It's almost getting closer to that doubling. It's just insane. So I don't know. We'll see what happens there. Okay, so I'm looking at the numbers. We got nothing for Amazon. We got nothing for Meta. And we have nothing for Apple. Remember, we'll be doing Meta at 4:30 to 5:30. And then we'll do Amazon at 5:30 to like 6:30. So we got those two calls coming in. Okay, let me get rid of all these tabs. We have too many tabs here. None of these stocks are okay. Oh wow, Amazon's green. Amazon's up 4%. Amazon's green. So the numbers are out. We don't have them publicly, but the numbers are out. Amazon is green. Let's see. Amazon's green. It's up. Someone knows something. Someone knows something. Let's go to Meta real quick. Is Meta green? Meta is red. It's flat. And then Apple's green, but it's barely green. All right, so Amazon's the big one. Amazon's up 4.7%. Who got the numbers? Let's see. Okay, Amazon's out. Oh, wow. This is a big beat. On Amazon. This is a big beat. Big beat. Here we go on Amazon. Here we go. Numbers are out. Amazon 4Q net sales, $169.96 billion. Estimated $166 billion. They beat revenue by $3 billion. Almost $4 billion. Wow. EPS $1 versus 78 cents. What a beat by Amazon. Wow. Amazon's up 5%. What a beat. That is incredible, dude. That's pretty damn amazing. Bro. Wow. Matt, I got to give you credit, man. Matt's been calling this on the live stream for the past like 2 months. That's up. Stock right now is up 4.6%, 165 on the stock. Guidance sales missed for next quarter. Okay, I'm trying to pull up the IR and see it come out. Okay, so that's Amazon. Do we have Apple and Microsoft? Not yet. We don't have Apple and Microsoft yet. Let me pull up the stock and then, or it's not Microsoft, Meta. All right, so Amazon beat 165, up 4%. You guys are saying they missed on guidance. Remember, Amazon beat last time as well, but then they tanked on the earnings call. I'm not saying that's going to happen again, but if guidance is a little bit of an issue, maybe we need to get clarity on that. But so far, the street doesn't really care. So let's see if we can get any updates there. Nothing I see on guidance yet. Let's see on Meta. Do we have any results for them yet? It might come out at 4:05. That's usually when it comes out. Meta, nope, nothing yet. All right, so we're still waiting. Damn, this is pretty good. This is a pretty good job for Amazon, dude. Not bad. This is not bad at all. Amazon, put in the chat which one of these you own. Amazon, Apple, or what's the other one? Meta. Put in the chat which one you own. Apple's red after hours, but barely. Meta's not moving. And Amazon's only up 3.7%, so it's coming down a little bit. But it's still up. It's still green. The algorithms are buying Amazon more than selling it as we get the numbers. We got Amazon, Apple, Amazon. Mostly you guys own Amazon. A little bit of Meta here. Numbers are not out for Meta yet. Apple, they are not out yet. Amazon, they are not out yet. Okay, so we're still waiting. We're still waiting on these guys to be out. Yeah, all right. Not yet. We're waiting. Meta's up. Okay, Meta's up. Meta came in. Wow, Meta's up 5%. Holy moly, Meta crushed. It's not out. I'm trying to find it. It should be here very soon. Oh boy, is it here? Someone's got it. It looks like they crushed. I think they did 40.1 billion in revenue. That's what it's looking like. So it looks like Meta did 40.1 billion and the street wanted 39 billion, so they beat by $1 billion. Wow, they're paying a dividend of 50 cents a share. Oh my God. Meta's giving a dividend of 50 cents a share. Meta's up 6%. Holy crap. They're giving a dividend. They're up 7%. Oh my goodness. These guys are giving a is the growth that so either the growth is slowing down and they're giving a dividend, or the growth is going crazy. Meta is giving shareholders a dividend of 50 cents a share. Wow. That is incredible stuff, dude. Who would have thought? This is one of the first big tech companies to give a dividend, dude. Like, to give a real dividend. I mean, I know Nvidia and Apple have a dividend, but 50 cents has to be like a 0.5% yield, something crazy. It has to be a very small yield, but it's up right now. It's up. It's up. Okay, I'm trying to get the real numbers. Give me 1 second, trying to get the numbers. But you can see right there, it's up and it's doing well. So Meta, let's see the numbers, dude. Okay, this is the numbers. 40.11 billion. Street expected 39.1. And an EPS of 533, beating 495. Wow. Congrats to Meta shareholders. Absolutely phenomenal. The stock is up 7.5%. Holy crap, dude. Meta killed it. I think the dividend is quarterly. I don't think it's annually. I'm pretty sure it's quarterly. We'll see in a second. But they're doing a buyback too. They're doing a buyback. Damn, the numbers got to load, dude. The numbers are still not on their website. We need these numbers. We need to run through the whole thing. Amazon numbers are still not on their website either. And Apple numbers are still not there. Wow. A dividend and a buyback. Oh my goodness. This is absolutely incredible. Look at Meta, up 8%. Dude, they're $420. This is insane. This is incredible, dude. People, I mean, like, it seemed like Meta was getting expensive at 400. Nope. This is why Zucks wasn't phased yesterday when they were telling him to apologize. He was just like, let me fucking do this stupid apology because I know I'm about to crush on earnings tomorrow and about to make a shit ton more money. So you guys can have your apology, but I'm about to go make some money. That's what Zucks was thinking last night. 50 billion buyback. That's what they approved. Oh yeah. This stock should be up even more. This is incredible. It's about to be up 9%. 50 billion buyback. 50 cents dividend. Apple is flat, so Apple numbers haven't come out yet. Amazon is still up 4.25%. This is way better than Google and Microsoft already. Way better. Did they not already do a buyback? They did. They bought back 70 billion of their shares at $270. So this is another $50 billion buyback. Wow. Let me put the chart on 5 minutes. Let's do it here. Let's do the 5-minute chart. Okay, so you guys can see it now. So there's the green candle. 430 on Meta. 430 on Meta. $430 on Meta. Wow. This is insane. This is big. This is big. Wow. This is big. Okay, I'm trying to get these Amazon numbers. Okay, Amazon's out. Q4 earnings is officially out. And Amazon, so Meta's at 430, Amazon's at up 164, and then Apple is still not out yet. Apple is still not out. It's probably going to be out in a second. Okay, so here we go. Let's go through Amazon's numbers real quick. We're gonna go deeper into them, but this is just high level overview stuff, and then we'll go deep. For those that are just joining, Meta crushed $50 billion buyback, 50-cent dividend, and Amazon also crushed, but it seems like guidance they took a little bit of a hit on, and that's the issue. So 170 billion, 14% year over year in terms of revenue. They beat that by 20 billion from last year. They did 149 billion last year. North America, 105 billion. International, 40 billion. AWS, 24.2. So AWS came in line, and North America International was fine. Net income, 10 billion, $1 per share. That's better than the 300 million they made in the fourth quarter of 2022. So 10 billion versus 300 million, a lot better. Full year sales, net sales increased to 574 billion. They did 574 billion of revenue in 2023. That is up 12% year over year. Operating income, 37 billion in profits versus 12 billion. So that's basically tripled. Or net, sorry, that was operating income. So net, but yeah, that's up triple. And then net income was 30 billion, which is also up almost double from last year. Now, where's their guidance? Where's their guidance? Let's see, because that's the thing people are saying. They have a bunch of stats we'll get into. Guidance. Do they give guidance? We also got to get into their advertising numbers. Okay, here we go. Guidance. Net sales are expected to be 138 to 145 billion. This quarter they brought in 170. So that's definitely lower quarter over quarter. That's significantly lower, actually, quarter over quarter. But that's okay. I think that usually happens Q1. Operating income is expected to be between 8 and 12 billion. That's also lower. This guidance assumes other things. Okay, so the revenue and operating income is down this quarter, which is why the stock is not mooning like Meta, but the stock is still up. The stock is still up. Okay, let's get into Meta. Let's get into Meta. Meta. All right, here we go. Meta's up, initiates quarterly dividend. There you go, folks. Meta is up 11%. Oh my God. Meta's up 11%. This is crazy. Dude, first of all, if you don't own Meta, that's okay. This is very good for the stock market. For a company like Meta to be up 11%, that is very good for consumer health, very good for advertising, very good for general liquidity. The $6 trillion that is on the sidelines, no matter what stock you own, that money does not want to be making 5.5% when Meta's going up 11% in 3 minutes. I mean, this is really good to get these types of results. It's very, very good for the market to see these types of results. All right, so let's bring up Meta's numbers. Meta. Here we go. So, Zuck says we had a good quarter, and as our community and business continue to grow, we made a lot of progress on our vision for advancing the metaverse. I wonder how much they're going to talk about the metaverse today. Let's see. These are the top line stats. Daily active people, 3.19 billion. The street wanted 3.11 billion. So they beat on DAP. That's up 8% year over year. How did they get another 8%, which is another 200-300 million people to use their products every day? I don't know, but they figured it out. Monthly active people, almost 4 billion. 3.98 billion. Almost 4 billion people are using this shit. Daily active users, 2.11 billion. That's what the street wanted. So that makes, and that's on Facebook specifically. MAUs, 3.07 billion. That's up 3%. DAUs are up 6%. These are just Facebook. All right, here's ad impressions. This is a big one. In the fourth quarter of 2023, ad impressions delivered across our family of apps, Instagram, Facebook, WhatsApp, etc., were up 21%, and the average price per ad was up 2%. Okay, so they delivered more impressions, and they were able to charge a little bit more for those impressions. For full year 2023, ad impressions are up 28%, and the average price per ad decreased 9%. That's not the worst thing. You want to make sure there's more impressions. That means more people are scrolling, and price is decreasing 9%. That's not the worst thing in the world. If you have more people obviously scrolling, the economies of scale take into effect, and you get a little bit of decreases on the unit costs. Revenue, 40.1 billion, 134 billion for the year. That's up 25%. Over a quarter over quarter, 16% year over year. Absolutely incredible. Costs and expenses, 23 billion in the quarter, 88 billion for the year, decrease of 8%. Those are all those layoffs, so they decreased expenses down. Capital expenditures were about 7 billion in the quarter, 28 billion for the year. Share repurchases, we repurchased 6 billion and 20 billion of our stock in the fourth quarter, so 26 billion in total. As of December 1st, 2023, we had 30 billion available for authorized share repurchases. We announced another 50 billion. So they can spend 80 billion on share buybacks. That's another reason you're seeing the stock go up, because all these investors are like, well, wait a second. The stock's at 440 right now. Wait a second. If Meta can just buy back their shares, then why are we scared to buy the stock? Because if they're going to buy back the stock, if they can put 80 billion back into the company, they're creating a massive floor to the stock. So worst case, maybe it goes down 10, 15%, but it's going to come back up as Meta buys the stock. They have 18 billion in debt, 67,000 employees. That's down 22% year over year. The product managers that, quite frankly, didn't do that much in Meta are gone. They decreased them by 22%. And they have 65 billion in cash, free cash flow, 11 billion, 43 billion for the fourth quarter, or 43 billion for the full year, 11 billion for the fourth quarter. Absolutely incredible. Absolutely incredible earnings by Meta. It was great. It was a great earnings. There's nothing more you can say. It was a great earnings. Meta's at 440 right now. Now, Apple has not moved. I don't know if the numbers haven't come out or the numbers come out at 430, but their numbers are not out yet. Let me go on Twitter. Let me check if those numbers are out. Yeah, this is incredible. This is incredible on Meta. Yeah, numbers are not out on Apple. I think maybe they do come out at 420 or something. Here's Meta visualized right here. Here's Meta. Meta is now a $1 trillion company. So Meta was a $1 trillion company at 390, but Meta has now solidified itself as a $1 trillion company. Revenue 40 billion, expenses 23. I mean, this is just incredible. Costs are decreasing, revenue's increasing. They blew away expectations. Dude, a 50-cent dividend is not too bad. I mean, now if you own Meta stock, you're not only getting capital appreciation, they're saying, hey, thanks for buying the stock. We'll give you 50 cents a share for every piece of stock you have. Apple's 430. Okay, so we have 15 minutes for Apple. Apple's 430. Wow. Meta's up 12.59%. I mean, dude, this is crazy. This is crazy. I wish I owned Meta. It's the one stock I've always been bullish on, but I just never got into a position. It's kind of like Tesla. Now I'm getting into Tesla because we've seen the dip, but Meta was one of those companies that I just never was able to establish a position. And at some point, you're like, all right, well, do I buy it when it's up 300%? Do I buy it when it's up 350%? Do I buy it when it's up 400%? Do I buy it when it's up 500%? Which is what Meta did from $88. And at 400, I was like, no, I don't buy it up 500%. But Meta said, you know what, Amit? Sucks to be you, because this shit's going to go up another 12%. And so you're going to have to deal with it. So congrats to those that own Meta. This is a big deal. Let me try to pull up their actual slide deck and see what they've got going on. This is big for Meta. Let's go to CNBC as well. Let's pull up the YouTube TV subscription that I pay way too much for these moments. Let's see what they're talking about. Okay, so they're live. Here we go. Let's get their updates on Amazon and Meta. Here we go.
But it's a comforting one, I think, if you've owned this stock now. The numbers are going to go up. Like the estimates are going to go up for these two companies, and that means as much as the stocks are going up, you know, they're following the fundamentals, and that's one of the reasons that the Mag 7 has become the Mag 7, is because at least in this cyclical environment, they're kind of dominating the production of earnings growth as well.
Wow. Yeah. All right, Mike, Paul, Victoria, Dan, don't go anywhere. You're all coming back for instant analysis of Apple's earnings, which are just moments away. But I got to make a clean break here because Clorox earnings are out. Kate Rogers.
I see what you did there.
Yes.
Love that pun, John. Nice work. So Clorox out with its second quarter earnings here.
Okay, so we don't care about Clorox because Meta is sweeping up and cleaning up the competition. Meta right here. So Apple's up a little bit, 187. So we got about 15 minutes till they come out. Meta's up 12%. Amazon's up 4.69%. Meta's up, and Amazon is up. Apple's still flat. Yeah, we'll get the Apple stuff in a second. But Amazon is up. Let me pull up a couple of other numbers, guys, real quick. Give me one sec. Someone said put a wrench. Yeah, let me get rid of that. Okay, so Amazon numbers. I want to go through a bunch of I want to go through advertising. So let me Command F advertising and see what they say here. So let me read off a couple things. They have 15 new advertising tools. They have Amazon Publisher Cloud, which is going to help with advertising. Advertising revenue. Okay, here's what I wanted to see. Advertising revenue. Oh my goodness. They did 14 billion in ads. Wow. I didn't expect that, dude. I was expecting like 11 billion or 10 billion. 14 billion in ads on Amazon. That's another reason the street should be up. I mean, the street should have the stock. Yeah, the stock's up 4.7%. I mean, that's another reason I would imagine it's up. 14 billion in ads is kind of ridiculous, dude. Like Meta just did 40 billion basically off ads. Amazon is doing almost half of what Meta's doing on ads just through Prime and just through like PPC, just like pay-per-click advertising. Wow. And AI is only going to make that better. Subscription, they brought in 10.4 billion. AWS 24 billion. Subscription is like Prime. Physical store is 5 billion. Online, so that's like Whole Foods. Third-party sellers, look at that, 43 billion they make off of third-party sellers. Now, the margin on that is not good, but still, that's incredible. And then 70 billion on the actual e-commerce business. They made 1 billion on a bunch of other things. Stock-based comp was 227 million in the quarter. No, that's cost of sales. Where's stock-based comp? Oh, they're showing it for the different segmented. Okay, so stock-based comp sales and marketing is 1.2 billion, tech and infrastructure 3.5. Total stock-based comp was 6.3 billion. That's not that crazy, dude. You're bringing in 170 billion in revenue to only pay 6 billion in SBC is not wild. That's not wild at all. All right, so Amazon subscription business amazing, advertising business amazing, and the streets rewarding it. This is way better than Google and Microsoft. Way better. I mean, Microsoft did great, but the stock had run up too much. Amazon's now up an official 5%, 167. Meta's up about 12% on the day. Election year ads will be banger this year. Yeah, so Amazon's not going to really well, no, Amazon with Prime TV, they're going to benefit from ads. I wonder how much Prime TV specifically is doing for ads. Meta, Google obviously will benefit. Amazon, if there's going to be election ads in between your Prime TV watching, then maybe they'll benefit, which I'm sure there will be. But Meta and Google are going to be the main beneficiaries. I can't believe Meta issued a dividend. That's the part I can't really believe. I mean, that's the tough one. So that's pretty. That dividend is just that is. Meta's up $45. Yeah, Meta's up $45. So this is. I'm trying to get the Meta doc right now. Let's get the Meta actual PR. Oh, we got Steve calling. Okay, just in time. Here we go. Steve, you're live with 800 people with me. We see the Amazon and Meta results. What are your initial thoughts?
I have one word for you with Amazon.
Go ahead.
Boom, motherfucker. I guess that's 3 words.
That's 2 words. That's 2 words. Look, dude, advertising came in well. Subscriptions came in well. They crushed.
Like, oh, input cost. What are input costs? What are input costs? Boom. Free cash flow improved to $36.8 billion for the TTM. Amazing. And it's only going to get stronger.
Guidance was a little low, but outside of guidance, they crushed on pretty much everything else. 14 billion in ads, 10 billion in subscription, 24 billion AWS, and
oh my God. Meta's up $46 right now.
You didn't see Meta? You didn't see Meta, or you were only focused on Amazon?
Oh my God. Oh, and they're initiating a dividend?
I'm so happy we get to see your reaction live, because that's exactly what I said, dude. They're giving a 50-cent dividend.
Dude.
What are your thoughts on that? Give me your raw thoughts. 50-cent dividend. What does that mean for Meta? Why is that so exciting?
I mean, for me, it's very exciting.
But in general, why do you think the market likes that? Is there any bearish thing about that because they're not growing as much? Is that why they're doing like what?
So that's the biggest misconception. People need to understand that just because a company pays a dividend does not mean that they are not growing anymore or not growing by as much. They are taking retained earnings and redistributing it back to shareholders rather than leaving it as cash on the balance sheet, which is fine because Meta is still freaking growing like a beast.
They are doing 50 billion in buybacks. What do you think about that?
Yeah, amazing.
Yeah, your name is Dividend Streams, and so the dividend must be exciting for you, right?
Well, we also have quite a bit of Meta, so I'm pretty freaking happy.
You and your wife, yeah.
Yeah.
Dude, this is way better than Google and Microsoft. I mean, Amazon's up 5%, Meta's up 12.2% right now. S&P is up. Wow, S&P is 491. S&P is up as well. Nvidia's up. SMCI is up. So we got Apple in 6 minutes. What do you what do you think is going to happen with Apple?
You got to remember, this is 50 cents per quarter. They just implemented a $2 dividend. This changes things for Meta. Dividend funds can now own it. It's now going to be looked at differently because people that are just focused on dividends can now buy Meta. I mean, there's a lot of upside for this. And this is going to be most likely a dividend grower, same like Apple, same like Microsoft. And eventually they'll have 25 years of growing the dividend. And trust me, you hold something that long, those dividends pile up when you reinvest them.
Do you also think the dividend plus the $50 billion buyback is creating a floor to the stock, which is why investors are excited?
Dude, a floor? You saw a floor last year. Like, this is just telling the market, we're generating cash hand over fist. We're going to reward shareholders, and we're going to keep generating cash hand over fist.
So someone in the chat says, is a 0.5% dividend yield really meaningful for Meta?
Depends how many shares you own.
That's true. That's true. That's true. Yeah, if you got thousands of shares, I mean,
you gotta look at it like this. Even if you think about it like this. Even when it went down to like 98, if you bought 100 shares and you put $9,800 into it, okay, you're now getting $200 a year from Meta.
yeah, for nothing. And you got a 5x, and you got a 5x on the stock, basically. 4x.
And they are most likely going to grow the dividend sequentially every year going forward. Like, you don't just start to implement a dividend like this,
right?
Not grow it. Like, Meta is going to try to do what Apple's doing. They're going to try to do what Microsoft is doing. And quite honestly, Google should have implemented a dividend also.
Yeah, this was such a strategic move by Zucks. I mean, I'm trying to find the bear case to this, because it's weird. It's weird that Google didn't do something like this, because as you said, they're doing this because they have so much damn cash. They don't know what to do other than to reward shareholders, which is great for the stock.
And look, you have a debate that's never going to end. What's better, buybacks or dividends?
They're doing both. They're doing both.
I like both, but at the same time, you'll have people that say they should just do more buybacks and pay out a dividend because of tax efficiency, et cetera, et cetera. I don't believe in that. And this is big because depending on how many shares you have, this is going to allow you to accumulate more shares without putting more money in. And don't be surprised if Meta splits their shares sometime this year. Don't be surprised on that.
Oh, yeah, 100%. Yeah,
Walmart
you're right.
Just issued a
3-for-1
split. That's going to happen in February, I think. I mean, Meta will eventually split shares, and that'll be great. And look, people will cite Berkshire never. Yeah, great. But how many people actually own Berk A shares? Not many. Like, you want companies to split their shares because having Meta at $50 rather than $400 or $450 gets you more people that can get involved and drive the volume higher.
Right. We got Apple in 2 minutes, Steve. By the way, you guys should be able to hear me. I got this little stand for the phone, so I think you guys should still be able to hear me. I have CNBC on live, so you'll be able to listen to it with me. But what do you think is going to happen with Apple in 2 minutes?
I mean, think about this. If Amazon reported big gains and they had a strong holiday season, it's going to be pretty hard for me to imagine a scenario where Apple doesn't report a good earnings report. Now, it may not be what people want to see because of how big they are, but I mean, I think that they're going to do well.
Yeah. It does seem like they're going to do okay. I got Dan Ives here, Steve. Let me play him and we can listen to him. We got literally a minute till earnings, so you can be with me here live if you can, and we'll get the numbers.
I should call my wife and tell her. She's probably not even looking at this.
With what Apple's done, I think we'll see her in a few minutes. But in this market, look, at the end of the day, Meta's not doing a dividend if they felt that doomsday was coming. It just shows, unless you have a telescope, hard to find that recession.
Victoria, how much does the quarter matter for Apple? Because we're reporting, sure, the fourth quarter, that's important to see. Q1, calendar Q1, typically not that strong. So is it a cost issue? Is it a staying power of the iPhone issue?
It's everything. Apple's fighting a war on multiple fronts right now. They have the argument about the App Store 30% payments. They've got kind of technology crackdown in China and obviously weak Chinese sales. They're staring the fifth straight quarter in a row of potentially falling sales. That's the longest streak since 2001. They kind of pre-warned on it, but fourth quarter is huge. It's the holiday sales. It's the new iPhone announcement. It's supposed to be their quarter, and they've just been mired. I mean, analysts are putting it at 1% growth potentially, but they even came out saying, hey, we're going to be flat year over year likely, and they're missing a catalyst. They've struggled with their blood pulse ox in the Apple Watch having to be disabled. They have a patent fight there. They've got fights with the EU on what they're doing with your App Store. They've got fights with China and slow sales there, and potentially they're starting to lose market share to the Chinese phones. And so they really have a lot of different headwinds. I see they're trying to pivot. We'll see what they talk about their VR
Victoria,
and their $3,500 headset.
It's 4:30 Eastern and Apple earnings are out. Steve Kovac has the numbers too. Steve.
Hey there, John. Yep, and it's a beat on the top and bottom lines for Apple. Let me go over those big numbers and then dive into the details here. EPS coming in $2.18. Street was expecting $2.10. Revenues growth again for the first time after 4 quarters of declining sales, $119.58 billion in revenue. Street was looking for $117.9 billion. That's about 2% revenue growth. Again, first growing quarter for Apple after 4 quarters of declines. iPhone, that is also a beat, $69.7 billion in sales there versus the $67.82 expected. I'm sorry, that was a slight miss on iPhone.
Okay, so we got the Meta call. I'm going to do like 2 seconds on Apple just to give you top line numbers, and then we'll get into the Meta call. It seems like Apple right now is kind of flat after hours. Apple right here at 184, it's down about 1%. So it's down because it looks like China is the reason they're missed in terms of their guidance. I'm trying to get the numbers real quick, then we'll go straight to Meta. We'll go straight to Meta and we'll listen to what Zucks has to say. All right, here we go. EPS 218 versus 221. That's a miss. Revenue 119.5 versus 118. That's a beat. After hours is red. iPad came in at 7.78 billion. iMac 7.7 billion. iPhone 69.7 billion. It looks like China is the issue, which is why the stock is red and why we're down about 0.63%. Okay, let's get to Meta. We'll do Amazon at 5:30. Amazon is at 5:30. Meta is at 4:30. So let me pull up Meta's call right now, and we'll get straight into Meta, and let's listen to what Zucks has to say, and let's keep doing it. All right, here we go. Here's Meta.
The earnings press release and an accompanying investor presentation are available on our website at investor.fb.com. And now I'd like to turn the call over to Mark.
All right. Hey, everyone. Thanks for joining us. This was a good quarter, and it wrapped up an important year for our community and our company. We estimate that there are more than 3.1 billion people who use at least one of our apps each day. 2023 was our year of efficiency, which focused on making Meta a stronger technology company and improving our business to give us the stability to deliver our ambitious long-term vision for AI and the metaverse. And last year, not only did we achieve our efficiency goals, but we returned to strong revenue growth, saw strong engagement across our apps, shipped a number of exciting new products like Threads, Ray-Ban Meta Smart Glasses, and mixed reality in Quest 3, and of course established a world-class AI effort that's going to be the foundation for many of our future products. I think that being a leaner company is helping us execute better and faster, and we will continue to carry these values forward as a permanent part of how we operate. Now, moving forward, a major goal will be building the most popular and most advanced AI products and services. And if we succeed, everyone who uses our services will have a world-class AI assistant to help get things done. Every creator will have an AI that their community can engage with. Every business will have an AI that their customers can interact with to buy goods and get support. And every developer will have a state-of-the-art open source model to build with. I also think that everyone will want a new category of computing devices that let you frictionlessly interact with AIs that can see what you see and hear what you hear, like smart glasses. And one thing that became clearer to me in the last year is that this next generation of services requires building full general intelligence. Previously, I thought that because many of the tools were social, commerce, or maybe media-oriented, that it might be possible to deliver these products by solving only a subset of AI's challenges. But now it's clear that we're going to need our models to be able to reason, plan, code, remember, and many other cognitive abilities in order to provide the best versions of the services that we envision. We've been working on general intelligence research and FAIR for more than a decade, but now general intelligence will be the theme of our product work as well. Meta has a long history of building new technologies into our services, and we have a clear long-term playbook for becoming leaders. And there are a few key aspects of this that I want to take some time to go through today. The first is world-class compute infrastructure. And I recently shared that by the end of this year, we'll have about 350,000 H100s, and including other GPUs, that'll be around 600,000 H100 equivalents of compute. We're well positioned now because of the lessons that we learned from Reels. We initially underbuilt our GPU clusters for Reels, and when we were going through that, I decided that we should build enough capacity to support both Reels and another Reels-sized AI service that we expected to emerge, so we wouldn't be in that situation again. And at the time, the decision was somewhat controversial, and we faced a lot of questions about CapEx spending, but I'm really glad that we did this. Now, going forward, we think that training and operating future models will be even more compute intensive. We don't have a clear expectation for exactly how much this will be yet, but the trend has been that state-of-the-art large language models have been trained on roughly 10x the amount of compute each year. And our training clusters are only part of our overall infrastructure, and the rest obviously isn't growing as quickly. But overall, we're playing to win here, and I expect us to continue investing aggressively in this area. In order to build the most advanced clusters, we're also designing novel data centers and designing our own custom silicon specialized for our workloads. The second part of our playbook is open source software infrastructure. Our long-standing strategy has been to build an open source general infrastructure while keeping our specific product implementations proprietary. In the case of AI, the general infrastructure includes our Llama models, including Llama 3, which is training now and is looking great so far, as well as industry standard tools like PyTorch that we've developed. And this approach to open source has unlocked a lot of innovation across the industry, and it's something that we believe in deeply. Now, I know that some people have questions about how we benefit from open sourcing the results of our research in large amounts of compute, so I thought it might be useful to lay out the strategic benefits here. The short version is that open sourcing improves our models, and because there's still significant work to turn our models into products, because there will be other open source models available anyway, we find that there are mostly advantages to being the open source leader, and it doesn't remove differentiation for our products much anyway. Now, more specifically, there are several strategic benefits. First, open source software is typically safer and more secure, as well as more compute efficient to operate due to all the ongoing feedback, scrutiny, and development from the community. Now, this is a big deal because safety is one of the most important issues in AI. Efficiency improvements and lowering the compute costs also benefit everyone, including us. Second, open source software often becomes an industry standard, and when companies standardize on building with our stack, that then becomes easier to integrate new innovations into our products. That's subtle, but the ability to learn and improve quickly is a huge advantage, and being an industry standard enables that. Third, open source is hugely popular with developers and researchers, and we know that people want to work on open systems that will be widely adopted. So this helps us recruit the best people at Meta, which is a very big deal for leading in any new technology area. And again, we typically have unique data and build unique product integrations anyway, so providing infrastructure like Llama as open source doesn't reduce our main advantages. This is why our long-standing strategy has been to open source general infrastructure, and why I expect it to continue to be the right approach for us going forward. The next part of our playbook is just taking a long-term approach towards the development. While we're working on today's products and models, we're also working on the research that we need to advance for Llama 5, 6, and 7 in the coming years, and beyond, to develop full general intelligence. It's important to have a portfolio of multi-year investments in research projects, but it's also important to have clear launch vehicles like future Llama models that help focus our work. We've worked on general intelligence in our lab, FAIR, for more than a decade, as I mentioned, and we've produced a lot of valuable work. But having clear product targets for delivering general intelligence really focuses this work and helps us build the leading research program. Now, the next key part of our playbook is learning from unique data and feedback loops in our products. When people think about data, and they typically think about the corpus that you might use to train a model up front. And on Facebook and Instagram, there are hundreds of billions of publicly shared images and tens of billions of public videos, which we estimate is greater than the common crawl data set. And people share large numbers of public text posts and comments across our services as well. But even more important than the upfront training corpus is the ability to establish the right feedback loops with hundreds of millions of people interacting with AI services across our products. And this feedback is a big part of how we've improved our AI systems so quickly with Reels and ads, especially over the last couple of years when we had to re-architect it around new rules. Now that brings me to the last part of our playbook for building leading services, which is our culture of rapid learning and experimentation across our apps. When we decide that a new technology, like AI recommended Reels, is going to be an important part of the future, we're not shy about having multiple teams experimenting with different versions across our apps until we get it right. And then we learn what works and we roll it out to everyone. And there used to be this meme that we'd probably launch stories on our settings page at some point. And look, I think it's kind of funny because it gets to a core part of our approach. We start by learning and tuning our products until they perform the way we want, and then we roll them out very broadly. And sometimes, occasionally products will blow up before we're ready for them to, like Threads. Although I'll note that Threads now has more people actively using it today than it did during its initial launch peak. So that one's, I think, on track to be a major success. But normally, we learn and we iterate methodically. And, we started doing that with our AI services in the fall, launching Meta AI, our assistant, AI Studio, which is the precursor to Creator AIs, our Alpha with Business AIs, and the Ray-Ban Meta Smart Glasses. And we've been tuning each of these, and we're getting closer to rolling them out more widely. So you should expect that in the coming months. From there, we'll focus on rolling out services until they reach hundreds of millions or billions of people. And usually only when we reach that kind of scale do we start focusing on what monetization will look like. And although in this case, the way that business AIs will help business messaging grow in WhatsApp Messenger and Instagram is pretty clear. But that's our basic approach. And I'm really excited about pointing our company at developing so many of these awesome things. Now, we have two major parts of our long-term vision. And in addition to AI, the other part is the metaverse. We've invested heavily in both AI and the metaverse for a long time, and we will continue to do so. These days, there are a lot of questions more about AI that I get, and that field is moving very quickly. But I still expect that this next generation of AR, VR, and MR computing platforms to deliver a realistic sense of presence that will be the foundation for the future of social experiences and almost every other category of experiences as well. Reality Labs crossed $1 billion in revenue in Q4 for the first time.
Wow.
With Quest having a strong holiday season. Quest 3 is off to a strong start, and I expect it to continue to be the most popular mixed reality device. With Quest 3 and Quest 2 both performing well, we saw that the Quest app was actually the most downloaded app in the App Store on Christmas Day. I want to give a shout out to Asgard's Wrath 2, which was developed by one of our in-house studios and received IGN's 10 out of 10 masterpiece rating, making it one of the best rated games out there, not just in VR, but of any game on any platform ever. It's a really good sign that we're able to deliver that quality of work at Meta. Horizon is growing quickly too. It is now in the top 10 most used apps on Quest, and we have an exciting roadmap ahead. This is another example of applying the long-term playbook that I discussed earlier with AI, but in another area. We take the time to build up the core technology and tune the experience, and then when it's ready, we're good at growing things. Now, our focus for this year is going to be on growing the mobile version of Horizon as well as the VR one. Ray-Ban Meta Smart Glasses are also off to a very strong start, both in sales and engagement. Our partner, EssilorLuxottica, is already planning on making more than we'd both expected due to high demand. Engagement and retention are also significantly higher than the first version of the glasses. The experience is just a lot better with Meta AI in there, as well as there's a higher resolution camera, better audio, and more. And we also have an exciting roadmap of software improvements ahead, starting with rolling out multimodal AI, and then some other really exciting new AI features later in the year. Now, I said this before, but I think that people are going to want new categories of devices that frictionlessly engage with AIs frequently throughout the day without having to take out your phone and press a button and point it at what you want to see. And I think that smart glasses are going to be a compelling form factor for this, and it's a good example of how our AI and metaverse visions are connected. In addition To AI in the metaverse, we're continuing to improve our apps and ads businesses as well. Reels and our discovery engine remain a priority and major driver of engagement, and messaging continues to be our focus for building the next revenue pillar of our business before our longer term work reaches scale. But since I went a bit longer on the other areas today, I'm just going to mention a few highlights here. Reels continues to do very well across both Instagram and Facebook. People reshare Reels 3.5 billion times every day. Reels is now contributing to our net revenue across our apps. The biggest opportunity going forward is unifying our recommendation systems across Reels and other types of video that will help people discover the best content across our systems no matter what format it's in. WhatsApp is also doing very well, and the most exciting new trend here is that it is succeeding more broadly in the United States, where there's a real appetite for a private, secure, and cross-platform messaging app that everyone can use. And given the strategic importance of the US and its outsized importance for revenue, this is just a huge opportunity. Threads is also growing steadily with more than 130 million monthly actives. And I'm optimistic that we can keep the pace of improvements and growth going and show that a friendly, discussion-oriented app can be as widely used as the most popular social apps. All right, that's what I wanted to cover today. Our communities are growing and our business is back on track. Once again, a big thank you to all of our employees, partners, shareholders, and everyone in our community for sticking with us and for making 2023 such a success. I'm looking forward to another exciting year ahead. And now here's Susan.
Thanks, Mark, and good afternoon, everyone. Let's begin with our consolidated results. All comparisons are on a year-over-year basis unless otherwise noted. Q4 total revenue was $40.1 billion, up 25% or 22% on a constant currency basis. Q4 total expenses were $23.7 billion, down 8% compared to last year. In terms of the specific line items, cost of revenue decreased 8%, driven mainly by lower restructuring costs that were partially offset by higher infrastructure-related costs. R&D increased 8%, driven primarily by higher headcount-related costs from Family of Apps and Reality Labs, as well as higher non-headcount-related Reality Labs operating expenses, which were partially offset by lower restructuring costs. Marketing and sales decreased 29%, due mainly to lower marketing spend and restructuring costs. G&A decreased 26%, due mainly to lower restructuring expenses. We ended the fourth quarter with over 67,300 employees, down 22% from a year ago, while up 2% from Q3 as our hiring efforts have resumed. Fourth quarter operating income was $16.4 billion, representing a 41% operating margin. Our tax rate for the quarter was 17%. Net income was $14 billion, or $5.33 per share. Capital expenditures, including principal payments on finance leases, were $7.9 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $11.5 billion, which reflects a $1.6 billion payment of income taxes deferred from prior quarters of 2023. We ended the year with $65.4 billion in cash and marketable securities and $18.4 billion in debt. In the fourth quarter, we repurchased $6.3 billion of our Class A common stock, bringing our total share repurchases for the full year to $20 billion. We had $30.9 billion remaining on our prior authorization as of December 31st, and today we announced a $50 billion increase in our stock repurchase authorization. Moving now to our segment results. I'll begin with our Family of Apps segment. In Q4, we saw continued community growth across the Family of Apps, as well as Facebook specifically. We're sharing today that, as previewed when we first introduced our family metrics, we are transitioning away from reporting Facebook-specific metrics. As part of this transition, we will no longer report Facebook daily and monthly active users or family monthly active people. In Q1, we will instead begin reporting year-over-year changes in ad impressions and the average price per ad at the regional level, while continuing to report family daily active people. For full year 2023, Family of Apps total revenue was $133 billion, and ad revenue was $131.9 billion, each up 16% year over year. The largest contributors to year-over-year ad revenue growth were the online commerce, CPG, entertainment and media, and gaming verticals. The online commerce and gaming verticals benefited from strong demand by advertisers in China reaching people in other markets. In 2023, revenue from China-based advertisers represented 10% of our overall revenue and contributed 5 percentage points to total worldwide revenue growth. Turning back to Q4 results. Q4 total Family of Apps revenue was $39 billion, up 24% year over year. Q4 Family of Apps ad revenue was $38.7 billion, up 24% or 21% on a constant currency basis. Within ad revenue, the online commerce vertical was the largest contributor to year-over-year growth, followed by CPG and gaming. On a user geography basis, ad revenue growth was strongest in Europe and rest of world at 33% and 32% respectively, followed by Asia Pacific at 23% and North America at 19%. Foreign currency was a tailwind to advertising revenue growth in all international regions. In Q4, the total number of ad impressions served across our services increased 21%, and the average price per ad increased 2%. Impression growth was mainly driven by Asia Pacific and rest of world. Pricing growth was driven by advertiser demand and currency tailwinds, which were partially offset by strong impression growth, particularly from lower monetizing surfaces and regions. Family of Apps other revenue was $334 million in Q4, up 82%, driven by business messaging revenue growth from our WhatsApp business platform. We continue to direct the majority of our investments toward the development and operation of our Family of Apps. In Q4, Family of Apps expenses were $18 billion, representing approximately 76% of our overall expenses. Family of Apps expenses were down 13% due to lower restructuring expenses. Family of Apps operating income was $21 billion, representing a 54% operating margin. Within our Reality Labs segment, Q4 revenue was $1.1 billion, up 47%, driven by Quest 3 sales during the holiday season. Reality Labs expenses were $5.7 billion, up 14% year over year, due primarily to higher headcount-related expenses and non-headcount-related R&D spend. Reality Labs operating loss was $4.6 billion. Turning now to the business outlook. There are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community, and our effectiveness at monetizing that engagement over time. On the first, we remain pleased with engagement trends and have strong momentum across our product priorities. We're seeing sustained growth in Reels and video overall, as daily watch time across all video types grew over 25% year over year in Q4, driven by ongoing ranking improvements. In-feed recommendations of posts from accounts you're not connected to also continue to drive incremental engagement as we increasingly personalize recommendations, and we expect to deliver further improvements this year. On Instagram, we're making strong progress increasing the freshness of recommended content, and a big focus for Facebook this year will be unifying our video experiences and ranking across the app, which should create a more seamless user experience and deliver increasingly relevant video recommendations. On WhatsApp, community growth remains strong, and we're seeing good traction with our Channels product, which has quickly scaled to over 500 million monthly active users since we rolled it out globally in September. We're also making good progress in areas that have the potential to grow people's engagement with our products in the longer term, such as Threads and generative AI. On Threads, we're coming into 2024 with strong product momentum and remain focused on introducing additional valuable features and further scaling the community this year. With generative AI, we fully rolled out our Meta AI Assistant and other AI chat experiences in the US at the end of the year and began testing more than 20 Gen AI features across our family of apps. Our big areas of focus in 2024 will be working towards the launch of Llama 3, expanding the usefulness of our Meta AI Assistant, and progressing on our AI Studio roadmap to make it easier for anyone to create an AI. For the experiences in our apps, we'll follow our typical approach of making them great before we lean into growth and eventually monetization. But this continues to be an exciting area that has the potential to transform how people engage on our services in the years ahead. Now to the second driver of our revenue performance, increasing monetization efficiency. There are two parts to this work. The first part is growing the level of ad inventory within organic engagement. Our approach to optimizing ad levels in our apps has become increasingly sophisticated over the years as we've developed a better understanding of the optimal place, time, and person to show an ad, which has enabled us to adopt a more dynamic approach to serving ads. We expect to continue that work going forward, while surfaces with relatively lower levels of monetization, like video and messaging, will serve as additional growth opportunities. The other part to increasing monetization efficiency is improving marketing performance. To do this, we're focused on three areas. The first is AI. We continue to leverage AI across our ad systems and product suite. We're delivering continued performance gains from ranking improvements as we adopt larger and more advanced models, and this will remain an ongoing area of investment in 2024. We're also building out our Advantage Plus portfolio of solutions to help advertisers leverage AI to automate their advertising campaigns. Advertisers can choose to automate part of the campaign creation setup process, such as who to show their ad to, with Advantage Plus Audience. Or they can automate their campaign completely using Advantage Plus Shopping, which continues to see strong growth. We're also now exploring ways to apply this end-to-end automation to new objectives. On the ads creative side, we completed the global rollout of two of our generative AI features in Q4, text variations and image expansion, and plan to broaden availability of our background generation feature later in Q1. Initial adoption of these features has been strong, and tests are showing promising early performance gains. This will remain a big area of focus for us in 2024. The second area of our work is helping businesses connect their marketing data and measure results. Here, we're continuing to invest in Conversions API to make it easier for advertisers to not only adopt, but maximize its impact. The last area is investing in new and engaging on-platform ad experiences. Business messaging remains a priority here. Click-to-message ads continue to grow, and we're seeing advertisers increasingly use these ads to drive down-funnel conversions. Paid messaging is growing quickly, and we are focused on broadening adoption in 2024 by making it easier for businesses to buy marketing messages and more easily adopt our Flows product to develop richer in-thread experiences for consumers. We're also progressing with our early testing on WhatsApp and Messenger of AIs for businesses that can provide conversational support and chat. We'll take our time to get these experiences right, but we think this will be a compelling opportunity that we're well positioned to deliver on. Outside of business messaging, we're making strong progress with our Shops ads products, which crossed a $2 billion annual run rate in Q4. Next, I would like to discuss our approach to capital allocation. We are in the fortunate position of being able to invest in many organic opportunities to improve the performance of our core business in the near term, while also making two significant longer time horizon investments in AI and Reality Labs. AI is a growing area of investment for us in 2024 as we hire to support our roadmap. We are also investing more in our AI infrastructure capacity this year. And given many of our ambitious forward-looking plans will rely on having sufficient compute capacity, We expect this to be an area we invest more aggressively in over the coming years. Reality Labs is the other long-term initiative we continue to invest heavily in as we progress on our efforts to develop the next computing platform. Aside from organic investments, returning capital to shareholders remains important to us. We believe our strong financial position and performance will enable us to invest in the business while also continuing to return capital to investors over time. We've historically done so through share repurchases, and while we expect to maintain an active share repurchase program, we are modestly evolving our approach going forward by returning a portion of capital through a regular dividend subject to quarterly board approval. In addition, we continue to monitor the active regulatory landscape, including the increasing legal and regulatory headwinds in the EU and the US that could significantly impact our business and our financial results. Of note, the FTC is seeking to substantially modify our existing consent order and impose additional restrictions on our ability to operate. We are contesting this matter, but if we are unsuccessful, it would have an adverse impact on our business. Turning now to the revenue outlook. We expect first quarter 2024 total revenue to be in the range of $34.5 to $37 billion. Our guidance assumes foreign currency is neutral to year-over-year total revenue growth based on current exchange rates. Turning now to the expense outlook. We expect full year 2024 total expenses to be in the range of $94 to $99 billion, unchanged from our prior outlook. We continue to expect a few factors to be drivers of total expense growth in 2024. First, we expect higher infrastructure-related costs this year. Given our increased capital investments in recent years, we expect depreciation expenses in 2024 to increase by a larger amount than in 2023. We also expect to incur higher operating costs from running a larger infrastructure footprint. Second, we anticipate growth in payroll expenses as we work down our current hiring underrun and add incremental talent to support priority areas in 2024, which we expect will further shift our workforce composition toward higher cost technical roles. Finally, for Reality Labs, we expect operating losses to increase meaningfully year over year due to our ongoing product development efforts in AR/VR and our investments to further scale our ecosystem. Turning now to the CapEx outlook. We anticipate our full year 2024 capital expenditures will be in the range of $30 to $37 billion, a $2 billion increase of the high end of our prior range. We expect growth will be driven by investments in servers, including both AI and non-AI hardware, and data centers as we ramp up construction on sites with our previously announced new data center architecture. Our updated outlook reflects our evolving understanding of our AI capacity demands as we anticipate what we may need for the next generations of foundational research and product development. While we are not providing guidance for years beyond 2024, we expect our ambitious long-term AI research and product development efforts will require growing infrastructure investments beyond this year. On to tax. Absent any changes to U.S. tax law, we expect our full year 2024 tax rate to be in the mid-teens. In closing, this was a pivotal year for our company. We increased our operating discipline, delivered strong execution across our product priorities, and improved advertising performance for the businesses who rely on our services. We will look to build on our priorities in each of those areas in 2024, while advancing our ambitious longer-term efforts in AI and Reality Labs. With that, Krista, let's open up the call for questions.
Thank you. We will now open the line for a question and answer session. To ask a question, please press star one on your touchtone phone. To withdraw your question, again, press star one. We do ask that you please limit yourself to one question. Please pick up your handset before asking questions to ensure clarity. If you are streaming today's call, please mute your computer speakers. And your first question comes from the line of Brian Nowak from Morgan Stanley. Please go ahead.
Great. Thanks for taking my questions. I have two. I appreciate, Mark, the color about sort of the learnings and the data and feedback loop. Let me ask you one about sort of the advertising business and all of the new machine learning and new Gen AI ad tools that you've built and rolled out the last year or so. Can you just talk about some of the largest areas of improvement your advertisers say is really driving this inflection of advertising? And what are the areas where you still get the most feedback on for further areas of improvement in the ad business that we should think about? And then Susan, maybe one on the first quarter guide, specifically on the acceleration implied. Anything on more color on which surfaces or ad units or regions are sort of giving you confidence in that type of acceleration at this point in the quarter? Thanks.
Hi. Thank you, Brian. I can take both of those. On your first question, what is driving strength in the ads business? We certainly believe that, we've been continuing to drive ad performance improvements, and year-over-year conversion growth remains strong, and we see this reflected in the feedback that we hear from advertisers also. There are really three areas of our work here that we're very focused on, and have been and will continue to be in 2024. First, just creating engaging on-platform ad experiences. We see that with formats like click-to-message ads, where we continue to see good momentum. Shops ads, we talked about the $2 billion annual run rate in Q4 after we just opened availability to all U.S. advertisers in Q2. Lead generation ads, another example. So we're really focused on creating engaging on-platform ad experiences. Second, we're really making it easier for advertisers to connect with their marketing data. We're continuing to invest in features like Conversions API, like AEM, and making these features easier to adopt, enhancing reporting and other performance. We've seen again that we get very positive feedback on advertisers who use those tools. And then finally, continuing to really use AI in important ways across our ads platform. For a long time, we have invested in building larger and more advanced models that have, resulted in more accurate predictions of relevant ads for people and improved performance for advertisers. And then, of course, we're investing a lot in AI-powered tools and products. So we're really scaling our Advantage Plus suite across all of the different offerings there, which really help to automate the ads creation process for different types of advertisers. And we're getting very strong feedback on all of those different features. Advantage Plus shopping obviously being the first, but Advantage Plus catalog, Advantage Plus creative, Advantage Plus audiences, etc. So we feel, like these are all really important parts of what has continued to grow improvements in our ads business, and will continue to going forward. On your second question, which is about the Q1 the Q1 revenue guide. This really just reflects a lot of the trends we saw in Q4, which is strong, broad-based advertising demand across verticals, particularly within online commerce and gaming. I'll also note that we get the benefit from having February 29th in this quarter. And again, just the, improvements that we continue to accrue to the business from all of our investments in improving ad performance over time.
Your next question comes from the line of Eric Sheridan from Goldman Sachs. Please go ahead.
Thanks so much. Maybe two questions if I can. Mark, coming out of a year like you had with the year of efficiency, what do you see as the key messages you want to share with investors about what you learned during the year of efficiency and how it might inform running an organization with the scale of ambition and just sheer organizational scale that Meta has on a long-term basis? That would be number one. And then Susan, I went back and looked. I don't think you've ever raised the high end of your CapEx guidance before, unless I'm mistaken. But with a wide range like that in CapEx, what should we be monitoring for what would push you towards either the lower end or the higher end of that CapEx guidance as you move through 2024? Thank you.
I'll take the first one. So the themes for the year of efficiency were to make us a stronger technology company by becoming leaner and more balanced towards our engineering work and more streamlined, and to improve our financial performance, primarily with the goal of providing stability, so we can invest in these long-term ambitious visions around AI and metaverse over what we see as the coming decade or more as these things play out. And I think a lot of people looked at what we were doing as if it might have been some kind of short-term thing, which that's never really our focus. But the part about making the company leaner, I think, is the more important part to take forward, right? Because obviously we're in a place now where the business is performing well, and I think the obvious question would be, okay, well, given that, should we just should we invest a lot more in things? And the biggest thing that's holding me back from doing that is that at this point I feel like I've really come around to thinking that we operate better as a leaner company. So even though it's always there are always these questions about like adding a few people here or there to do something, and I guess I just have more of an appreciation about how all of that adds up, and in the near term maybe makes you go a little bit faster, but over the long term the discipline to kind of hold things to a more streamlined level actually improves the overall company performance. So I'm really focused on that. In 2024, we do have a big recruiting backlog from last year, because part of the layoffs that we did included teams basically swapping out certain talent profiles for others, and we still need to hire some of the other talent profiles that we swapped people out for, and that will be ongoing through this year. But in terms of new headcount that we added to the plan, it's relatively minimal compared to what we would have done historically, and I sort of expect that for the next period of time going forward, even beyond 2024, my operating assumption is that we will also try to keep it relatively minimal, because I think that until we reach a point where we're just really underwater on our ability to execute, I kind of want to keep things lean, because I think that's the right thing for us to do culturally. So that's kind of the best window into how I'm thinking about this. The other piece that I guess somewhat dovetails into what Susan is going to talk to next is that a big part of why I wanted to improve our profitability is to give ourselves the ability to go through what is a somewhat unpredictable and volatile period over the next 5 or 10 years. There are different risk factors that are geopolitical or regulatory or different things, but also the technology landscape is somewhat unknown, and we want the ability to be able to surge investment on things like building out larger training clusters or just making different investments where that's necessary. And in order to make sure that we had the flexibility to do that, we want to make sure that we keep our cost structure to a point where we sort of have some extra space built in. So those are really the 2 points. That was the theme that I laid out at the beginning of the year of efficiency last year: make us a stronger technology company and give us the flexibility and stability to execute the long-term goals. And those remain, I think, the big focuses going forward on that.
And I can take the second question, Eric. So, we're really continuing to evolve our AI roadmaps and ambitions and our understanding of the capacity demands that we might have as we train the next generations of foundation models and to support, all of the associated product development going forward. So the increase in the top end of the range really reflects that evolving understanding of how much demand we may need. And we're also continuing to keep a close eye on supply availability. Where we land in that range is a function of both the supply and demand factors I mentioned. And this continues to be a pretty dynamic planning process for us. And there are also certainly, other factors that drive uncertainty. How quickly can we execute on the new data center architecture, how the supply chain turns out to unfold over the course of the year. But our expectation is generally that we will need to invest more to support our AI work in the years ahead, and we're seeing some of that reflected in 2024.
Your next question comes from the line of Mark Shmulik from AllianceBernstein. Please go ahead.
Yes, thank you for taking my questions. Mark, you mentioned at the top of the call this vision, kind of everyone having a meta AI assistant to kind of get things done. Previously when we were talking about the metaverse, from a time horizon perspective, we were looking at, a decade to kind of get there. But given kind of the pace of innovation around AI that you've seen, has that timeline changed? And do you think we'll get there quicker And then second question for Susan, just quickly on shop ads. Appreciate the color. And obviously we've had the Amazon partnership news intra-quarter. We know Meta's made a few attempts at getting kind of more integrated into shopping, over the last few years. Can you share some of the learnings and I guess what's different this time around? Thank you.
Sure, I could take the first one. I do think that AI is going to make all of the products and services that we use and make better. So it's hard to know exactly how that will play out. But for the work in Reality Labs specifically, there's a bunch of areas. Like if you take smart glasses, before we thought that we would have to build like full displays and holograms and deliver the sense of presence before that became a mainstream product. And now it seems quite possible that smart glasses that have AI assistants built in will be the killer app, and that the holograms and sense of presence will come later as a, maybe on the same time horizon that we were talking about before, but could end up being just as important as we expected. But there could be a big market here even before that. So I think we'll figure that out over the next few years. But yeah, I mean, overall, I think the two go together pretty hand in hand. I would have predicted that a lot of the parts of Reality Labs, I guess the sequence in technology is sometimes surprising. We always kind of expected that as part of building glasses or and any of these platforms that having an AI assistant would be a foundational part of it. But the fact that there have just been big strides in that over the last year or two is a big opportunity for these products sooner. So I think it's still unknown exactly how that will play out, but I think we'll know more over the next few years. It's very exciting though.
And Mark, I can take the second question. So first of all, online commerce continues to be one of our strongest verticals overall. And a lot of the work that we do to improve ads performance generally, really, helps do things like grow, conversions year over year, improves the performance of direct response ads. We've invested a lot in, the Advantage Plus set of tools like Advantage Plus Shopping. So I would say that our offerings for e-commerce advertisers overall are very strong, and we continue to invest in making them better and more performant. On Shops ads, specifically, this is an area where, we are really, I would say, focusing on introducing improvements that continue to make it easier for businesses to onboard to Shops. So, for example, eligible Shopify businesses can now onboard to Shops on Facebook and Instagram very seamlessly, and we're making it easier for advertisers to turn their existing ads into Shops ads. And we'll continue to focus on deepening integrations with partners and leveraging AI to make Shops ads even more performant. You mentioned the Amazon ads pilot, and that's a place where we're partnering with Amazon to make Buy with Prime to create a more seamless shopping experience on Facebook and Instagram, so that it's easier for people to purchase directly from an Amazon ad. This is really early, and we're testing this experience with them, but it's another avenue for us to explore how can we make the shopping experience easier for folks on our platform.
Your next question comes from the line of Justin Post from Bank of America. Please go ahead.
Great. I was wondering if you could help us think about the messaging run rate for revenues and maybe the long-term opportunity and how you think about that going forward on a multi-year basis. And then secondly, the guidance for Q1 suggests stable growth at the midpoint despite comps getting tougher. So I'm wondering if you could help us at all think about, the comps get increasingly tougher as we go through the year, how you're thinking about those comps and how you could grow in the second half. Thank you.
Thanks, Justin. I can take both of those. So on your first question about messaging monetization, right now the two primary avenues that we have there are click-to-messaging ads and paid messaging, which we are investing a lot in both to facilitate the full cycle of customer engagement. We saw that revenue growth from click-to-message ads remained strong in Q4. We see broadening advertiser adoption. And there I would say that our focus in terms of where we're investing is really around enhanced optimization and reporting. So we're really trying to drive down funnel performance, enabling businesses to optimize for purchase. And we've seen strong growth in purchase optimization revenue on click to messenger ads since we've rolled that out. And we're planning to bring purchase optimization to click to WhatsApp campaigns this year. And, across the click to messaging ads, we're introducing more robust reporting to help advertisers kind of understand how people are engaging with them via click to messaging ads and what is the value of that engagement. And then, of course, in the longer term, this is a place where we're excited about the opportunities for increased automation to really help businesses scale their ability to have conversations with their consumers. On the paid messaging side, this is much earlier, of course, but we're seeing good momentum driven by particularly strong growth from marketing messages. And we've also seen good results from our updated pricing model that we introduced in June. And here, we're really focused on making paid messaging easier to buy. So we're now testing the ability for businesses to send paid messaging directly on Meta Ads Manager. And then again, similar to click to messaging, we are investing in ways to make it easier to get more done within the app. So here we launched Flows globally in October, which enables businesses to offer richer user experiences within WhatsApp. Things like selecting a seat on a flight or booking an appointment. We're seeing good early traction, and we're focused on just introducing more ways to help businesses easily create flows, and we'll plan on introducing more capabilities here. So there's a lot, I would say, going on in the portfolio of messaging monetization work that we're doing. Now, your second question was around the 2024 outlook. And, we obviously have not shared any guidance beyond Q1, but, our revenue for the full year is going to be influenced by a number of factors, including macro conditions that are certainly harder to predict the further out you go. And over the course of 2024, as you said, we'll also be lapping periods of increasingly, strong demand. So we don't provide guidance beyond Q1. There's certainly a range of outcomes, and we'll have a better read on how we will compare to future quarters as we progress through the year.
Your next question comes from the line of Doug Anmuth from JP Morgan. Please go ahead.
Thanks for taking the questions. One for Mark, one for Susan. Mark, I believe you shifted Fair out of Reality Labs and into the family of apps. Can you just talk about some of the benefits there of moving that group as you pursue general intelligence? And then, Susan, can you just walk us through your thought process on adding a dividend to your capital returns at this stage beyond the share repurchases? Thank you.
I can talk to the first one. Yeah, the whole reason why we moved Fair is basically to be closer to the Gen AI group. They're both research groups. The Gen AI group basically builds our Llama launch vehicles and products, but also conducts a fair amount of research too, especially things that are going to be coming into the upcoming versions of Llama. Fair is focused on more foundational work and longer term work. So it's I'd say, more things that might be a couple years out to 10 plus years out. And as we, I guess here's one way to think about it. A lot of last year and the work that we're doing with Llama 3 is basically making sure that we can scale our efforts to really produce state-of-the-art models. But once we get past that, there's a lot more kind of different research that I think we're going to be doing that's going to take our foundation models in potentially different directions than other players in the industry are going to go in, because we're focused on specific vision for what we're building. So it's really important as we think about what's going to be in Llama 5 or 6 or 7 and what cognitive abilities we want in there and what modalities we want to build into future multimodal versions of the models. We need to be doing that work in advance and to research those things. And it helps to even though Fair and Gen AI will continue to be two kind of separate groups on different time horizons, I think to have some level of alignment between on the vision of what we're building between the two of them, so that way the Fair team can have in mind, hey, if we research this, then maybe it can intercept Llama 6 or something. Then that that I think is just going to be more helpful for increasing the ambition and focus of all of the work that we do. It's one of the reasons why I talked about. We did open-ended research on an AI for a while, but having a clear product target with these AI agents, I think, is really going to help focus the work and give us a feedback loop that's going to increase the productivity and output that we get dramatically.
Doug, on your second question about why now in terms of initiating a dividend, returning capital to shareholders remains an important priority for us, and we believe introducing a dividend really just serves as a nice complement to the existing share repurchase program. The dividend doesn't change how much we will be, or it doesn't change the way we determine the total amount of capital we return. And we expect that share repurchases will continue to be the primary way that we return capital to shareholders. But introducing a dividend just gives us a more balanced capital return program and some added flexibility in how we return capital in the future.
Your next question comes from the line of Ron Josey from Citi. Please go ahead.
Great. Thanks for taking the question. Mark, I hope your knee is getting better. I wanted to ask you about Apple opening up its App Store in Europe and maybe what role that might play for Meta and further building out the App Store, app install ads, and things along those lines. And Susan, as a follow-up to maybe a prior question, you mentioned the potential around business messaging and what the team's doing around really testing with WhatsApp and Messenger. Just talk to us how you might see this unfold, maybe with AI Studio, and any timing would be helpful. Thank you.
I don't think that the Apple thing is going to have any difference for us, because I think that the way that they've implemented it, I would be very surprised if any developer chose to go into the alternative app stores that they have. They've made it so onerous, and I think so at odds with the intent of what the EU regulation was, that I think it's just going to be very difficult for anyone, including ourselves, to really seriously entertain what they're doing there. Susan, did you want to add anything?
Nope. I was going to take the second question, I think, which was around the rollout of some of the Gen AI features from a monetization perspective. And, first of all, I would say that we don't expect our Gen AI products to be a meaningful 2024 driver of revenue. But, we certainly expect that they will have the potential to be meaningful contributors over time. Right now, the most near-term monetization opportunity is with our ad creative tools. We've talked about some of the places that we've been rolling those features out broadly, with text variations and image expansion now globally available. And we're seeing those tools receive adoption and provide real value for advertisers even at this early stage. And we're going to keep investing in making those more useful and performant, which then leads to more advertiser adoption. And that can be sort of a virtuous feedback loop. Over a longer time frame, the Gen AI features that we're bringing to business messaging, which I think was where your question originated, we think really represents a compelling opportunity. We're testing AI chats on a very small scale today with a few businesses, but it will take time to continue making those AIs increasingly useful. We're hearing good feedback from the businesses testing them, and we expect to make progress this year as we expand our tests further. I'd say one other thing is just on the consumer side. Again, we think Gen AI can make it easier for people to produce compelling content across all of our apps, including our messaging apps. And our AI assistant, certainly provides also added utility. So in all of these areas, I would say we're following our typical playbook of testing and tuning the experiences until, they're very good. And then we'll invest in growth and eventually explore monetization.
Krista, we have time for one last question.
Your last question comes from the line of Ross Sandler from Barclays. Please go ahead.
Great. Mark, just curious what you're seeing with Meta AI at this stage. You talked about rapid iteration of that, given your large audience. So yeah, I guess what's going on thus far? Which of the apps in the family of apps has seen engagement increase from Meta AI, and do you think that there could be?
All right, we're gonna stop Meta and go to Amazon because they're starting soon. In terms of Meta's, that was a phenomenal earnings call. Meta right now is up a lot. If you own Meta, congrats. I mean, This is a company that executed. Google has a lot to learn from how Meta just did that presentation. 172 on Amazon. Amazon just absolutely crushed as well. Top line growth beat expectations by about $4 billion. Meta 451, up 14%. Doesn't look like the street's going to sell this off tomorrow either, if I had to guess, because the dividend is there, the buybacks are there. Like, what's the reason to sell outside of taking profits? And some people will take profits, but it seems like they didn't give you a reason to take profits because the thing's just going to keep doing well. So Meta right now doing pretty good. And now let's get into Amazon. We got an hour of Andy Jassy telling us how they're going to grow.
After the presentation, we will conduct a question and answer session. Today's call is being recorded. For opening remarks, I will be turning the call over to the Vice President of Investor Relations, Mr. Dave Files. Thank you, sir. Please go ahead.
Hello, and welcome to our Q4 2023 financial results conference call. Joining us today to answer your questions is Andy Jassy, our CEO, and Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have our press release in front of you, which includes our financial results as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2022. Our comments and responses to your questions reflect management's views as of today, February 1st, 2024 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates, changes in global economic and geopolitical conditions and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now, I'll turn the call over to Andy.
Thanks, Dave. Today we're reporting $170 billion in revenue, up 13% year over year, excluding the impact from foreign exchange rates. $13.2 billion in operating income, up 383% year over year, or $10.5 billion, and $35.5 billion in trailing 12-month free cash flow adjusted for equipment finance leases, up $48.3 billion year over year. While we've made meaningful progress in our financial measures, what we're most pleased about is the continued customer experience improvements across our businesses. These results represent a lot of invention, collaboration, discipline, execution, adjusting, and reimagining from teams across Amazon. Looking back at Q4, I'll start with our stores business, where customers responded to our continued focus on selection, price, and convenience. We continue to have the broadest retail selection with hundreds of millions of products available and added tens of millions of new items last year alone, including fashion selection from Coach, Victoria's Secret's fashion, Pit Viper, and Beyoncé's Renaissance Tour merch, to cosmetics from Lancôme, Urban Decay Cosmetics, and No Beauty by Vanessa Hudgens, to consumer technology and services from Boost Infinite and Whoop, to homewares from Martha Stewart. Being sharp on price is always important, but particularly in an uncertain economy where customers are careful about how much they're spending. We kicked off the holiday season with Prime Big Deal Days, an exclusive event for Prime members to provide an early start on holiday shopping. This was followed by our extended Black Friday and Cyber Monday holiday shopping event, which was open to all customers and ended up being our largest event ever. These events also helped attract new customers and Prime members. Throughout the quarter, customers saved nearly $10 billion across millions of deals and coupons, almost 70% more than last year. In addition to offering great deals, we continue to improve delivery speeds. In 2023, Amazon delivered to Prime members at the fastest speeds ever, with more than 7 billion items arriving same or next day, including more than 4 billion in the US and more than 2 billion in Europe. In the US, this result is the combination of two things. One is the benefit of regionalization, where we re-architected the network to store items closer to customers. The other is the expansion of same-day facilities, where in the US in the fourth quarter, we increased the number of items delivered the same day or overnight by more than 65% year over year. As we're able to get customers' items this fast, it increases the number of occasions that customers choose Amazon to fulfill their shopping needs, and we can see that in all sorts of areas, including how fast our everyday essentials business is growing. Our regionalization efforts have also brought transportation distances down, which has helped lower our cost to serve. In 2023, for the first time since 2018, we reduced our cost to serve on a per-unit basis globally. In the US alone, cost to serve was down by more than 45 cents per unit compared to the prior year. Lowering cost to serve allows us not only to invest in speed improvements, but also afford adding more selection at lower average selling prices or ASPs and profitably. We have a saying, it's not hard to lower prices, it's hard to be able to afford lowering prices. The same is true with adding selection. It's not hard to add lower ASP selection, it's hard to be able to afford offering lower ASP selection and still like the economics. Like improving speed, adding selection puts us in the consideration set for more purchases. As we look toward 2024 and beyond, we're not done lowering our cost to serve. We've challenged every closely held belief in our fulfillment network and reevaluated every part of it, and found several areas where we believe we can lower costs while also delivering faster for customers. Our inbound fulfillment architecture and resulting inventory placement are areas of focus in 2024, and we have optimism there's more upside for us. Alongside our stores business, our advertising growth remains strong, up 26% year over year, which is primarily driven by our sponsored ads. We've recently added sponsored TV to this offering in the US, a self-service solution for brands to create streaming TV campaigns with no minimum spend, putting this advertising within reach of any business. While still early days, streaming TV advertising continues to grow quickly. Brands are using our capabilities to reach engaged viewers on Twitch, Freevee, Fire TV, and Prime Video shows and movies, which just launched in the US, as well as Thursday Night Football. Shifting to AWS, revenue in the quarter grew 13% year over year in Q4 versus 12% year over year in Q3, and we're now approaching an annualized revenue run rate of $100 billion. We watched the incremental revenue added each quarter, and in Q4, AWS added more than $1.1 billion in incremental quarter-over-quarter revenue, which on an FX-neutral basis is more than any other cloud provider as far as we can tell. While cost optimization continued to attenuate, larger new deals also accelerated, evidenced by recently inked agreements with Salesforce, BMW, NVIDIA, LG, Hyundai, Merck, MUFG, Axiata, Cathay, BYD, Accor, Amgen, and SAIC. Our customer pipeline remains strong as existing customers are renewing at larger commitments over longer periods and migrations are growing. 2023 also was a very significant year of delivery and customer trial for generative AI, or Gen AI, in AWS. You may remember that we've explained our vision of 3 distinct layers in the Gen AI stack, each of which is gigantic and each of which we're deeply investing. At the bottom layer, where customers who are building their own models run training and inference on compute where the chip is the key component in that compute, we offer the most expansive collection of compute instances with NVIDIA chips. We also have customers who would like us to push the price-performance envelope on AI chips, just as we have with Graviton for generalized CPU chips, which are 40% more price-performant than other x86 alternatives. And as a result, we've built custom AI training chips named Trainium and inference chips named Inferentia. At reInvent, we announced Trainium 2, which offers 4 times faster training performance and 3 times more memory capacity versus the first generation of Trainium, enabling advantageous price performance versus alternatives. We already have several customers using our AI chips, including Anthropic, Airbnb, Hugging Face, Qualtrics, Ricoh, and Snap. In the middle layer, where companies seek to leverage an existing large language model, customize it with their own data, and leverage AWS's security and other features, all as a managed service, we've launched Bedrock, which is off to a very strong start with many thousands of customers using the service after just a few months. The team continues to rapidly iterate on Bedrock, recently delivering capabilities including guardrails to safeguard what questions applications will answer, knowledge bases to expand models' knowledge base with retrieval augmented generation or RAG and real-time queries, agents to complete multi-step tasks, and fine-tuning to keep teaching and refining models, all of which will help customers' applications be higher quality and have better customer experiences. We also added new models from Anthropic, Cohere, Meta with Llama 2, Stability AI, and our own Amazon Titan family of LLMs. What customers have learned at this early stage of Gen AI is that there's meaningful iteration required in building a production Gen AI application with the requisite enterprise quality at the cost and latency needed. Customers don't want only one model. They want different models for different types of applications and different size models for different applications. Customers want a service that makes this experimenting and iterating simple. And this is what Bedrock does, which is why so many customers are excited about it. At the top layer of the stack is the application layer. One of the very best early Gen AI applications is a coding companion. At reInvent, we launched Amazon Q, which is an expert on AWS, writes code, debugs code, tests code, does translations like moving from an old version of Java to a new one, and can also query customers' various data repositories like intranets, wikis, or from over 40 different popular connectors to data in Salesforce, Amazon S3, ServiceNow, Slack, Atlassian, or Zendesk, among others, and answer questions, summarize this data, carry on a coherent conversation, and take action. It was designed with security and privacy in mind from the start, making it easier for organizations to use generative AI safely. Q is the most capable work assistant and another service that customers are very excited about. By the way, don't underestimate the point about Bedrock and Q inheriting the same security and access control as customers get with AWS. Security is a big deal, an important differentiator between cloud providers. The data in these models is some of companies' most sensitive and critical assets. With AWS's advantaged security capabilities and track record relative to other providers, we continue to see momentum around customers wanting to do their long-term Gen AI work with AWS. We're building dozens of Gen AI apps across Amazon's businesses, several of which have launched and others of which are in development. This morning, we launched Rufus, an expert shopping assistant trained on our product and customer data that represents a significant customer experience improvement for discovery. Rufus lets customers ask shopping journey questions like, what is the best golf ball to use for better spin control? Or which are the best cold weather rain jackets? And get thoughtful explanations for what matters and recommendations on products. You can carry on a conversation with Rufus on other related or unrelated questions, and it retains context coherently. You can sift through our rich product pages by asking Rufus questions on any product features, and it'll return answers quickly. We're at the start of what Rufus will do, with further personalization and expansion coming, but we're excited about how it'll make discovery even easier on Amazon. Gen AI is and will continue to be an area of pervasive focus and investment across Amazon, primarily because there are few initiatives, if any, that give us the chance to reinvent so many of our customer experiences and processes, and we believe it'll ultimately drive tens of billions of dollars of revenue for Amazon over the next several years. In addition to our stores and AWS businesses, we continue to make progress on newer business investments that have the potential to be important to customers and Amazon long term. Touching on two of them. In October, we hit a major milestone in our journey to commercialize Project Kuiper, which is our low Earth orbit satellite initiative that aims to provide broadband connectivity to the 400 to 500 million households who don't have it today. We launched 2 end-to-end prototype satellites into space and successfully validated all key systems and subsystems, made a two-way video call, streamed a Prime Video movie in Ultra HD 4K, and made an Amazon purchase over our end-to-end communication network. It's rare to be able to exercise all these elements in an initial launch like this. We're on track to launch our first production satellites in the first half of 2024 and start beta testing in the second half of the year. We've still got a long way to go, but are encouraged by our progress. During the quarter, we also completed our second season of Thursday Night Football, which was a rousing success by all accounts. The customer experience continued to improve as our talent, production, streaming quality, analytics, and unique AI features like Prime Vision and defensive alerts all took big leaps forward on top of their very good start last year. We launched a new NFL tradition with the inaugural Black Friday football game, and our continuous innovation resonated with viewers as the number of people watching increased 24% year over year, and with advertisers as we made dramatic year over year gains in ad sales. We have increasing conviction that Prime Video can be a large and profitable business on its own, and will continue to invest in compelling exclusive content for Prime members like Thursday Night Football, Lord of the Rings, Reacher, Mr. and Mrs. Smith, Citadel, and more. And with the addition of ads in Prime Video, we'll be able to continue investing meaningfully in content over time. I'll close by reiterating that 2023 was a really good year, and I'm grateful to all of our teams who delivered on behalf of customers. Yet, I think every one of us at Amazon believes this is just the start of what's possible. We have a long way to go in every one of our businesses before we exhaust how we can make customers' lives better and easier, and there is considerable upside in each of the businesses in which we're investing. With that, I'll turn it over to Brian.
Thanks, Andy. Overall, we saw strong performance in the fourth quarter. Worldwide revenue was $170 billion, representing an increase of 13% year over year, excluding the impact of foreign exchange, and approximately $3 billion above the top end of our guidance range. Saw our highest quarterly worldwide operating income ever, which was $13.2 billion for the quarter, an increase of $10.5 billion year over year, and $2.2 billion above the high end of our guidance range. For the full year 2023, we had a meaningful improvement across our financial results. Revenue was $574.8 billion, an increase of 12% year over year, excluding the impact of foreign exchange. Operating income tripled year over year to $36.9 billion. Trailing 12-month free cash flow, adjusted for equipment finance leases, was $35.5 billion, up $48.3 billion versus last year. These financial outputs are a result of a lot of improvements in our key input metrics, such as stores' cost to serve, which decreased year over year for the first time since 2018, and in our ability to deliver to customers at our fastest speeds ever. I want to thank our customers, our partners, and our teammates around the world for a very strong 2023 performance. Focusing on the fourth quarter, North America revenue was $105.5 billion, an increase of 13% year over year, and an acceleration of 200 basis points compared to Q3. International revenue was $40.2 billion, an increase of 13% year over year, excluding the impact of foreign exchange, also an acceleration of 200 basis points compared to Q3. During the quarter, we remained focused on the inputs that matter most to our customers: price, selection, and convenience. Our shopping events throughout the quarter included Prime Big Deal Days in October, and our extended Black Friday and Cyber Monday shopping event helped to attract new Prime members and deliver billions in savings for customers. We made meaningful progress on delivery speeds in the United States and globally, which helped strong sales throughout the quarter, including notable strength in the last-minute gifting, where our ability to provide fast shipping helped our Prime members ensure that they got their gifts before the holidays. These improvements in delivery speed have led to increased purchase frequency by our Prime members across all of our major geographies. It also strengthened demand for our everyday essentials, categories like beauty and health and personal care, where speed is even more important to customers. Third-party sellers were a big part of our success over the holidays, with worldwide third-party seller services revenue growing at 19% year over year, excluding the impact of foreign exchange. And worldwide third-party seller unit mix was 61%, its highest level ever. We also saw strong performance in worldwide advertising, which grew 26% year over year, excluding the impact of foreign exchange. The strength in advertising was primarily driven by sponsored products, as our teams work hard to increase the relevancy of the ads we show customers by leveraging machine learning. Advertising only works if the ads are helpful to customers, and there's a lot of value in tailoring sponsored products so they are relevant to what a customer is actually searching for. We're also continually focused on improving our measurement capabilities, which allow brands to see the payback of their advertising spend. Shifting to profitability, North America segment operating income was $6.5 billion, an increase of $6.7 billion year over year, resulting in an operating margin of 6.1%. up 120 basis points quarter over quarter. Since North America operating margins were at their recent low levels in Q1 of 2022, we have now seen 7 consecutive quarters of improvement, resulting in a cumulative improvement of 800 basis points over these past 7 quarters. In addition to the strong top-line growth, which helped to drive improved leverage throughout our businesses, we continue to make progress on reducing our cost to serve. The fourth quarter is our busiest time of year, supported by an increasingly large and integrated operations network. Overall, our teams executed extremely well, yielding strong efficiency gains with minimal disruptions. We were pleased with the performance of our regionalized network during the holiday period, where we saw benefits from improved inventory placement, helping drive faster speeds and also lowering costs. We also continue to see benefits from lower transportation rates, which include line haul, ocean, and rail, and from a more stable labor market, resulting in improved staffing levels. In our international segment, we had an operating loss of $419 million, an improvement of $1.8 billion year over year. This improvement was primarily driven by lowering our cost to serve through increased units per box, lower transportation rates, and leverage across our fixed costs, as we continue to focus on customer inputs and improve efficiencies within our operations. The international segment represents more than 20 countries of varying degrees of growth. In our largest established countries like the UK, Germany, and Japan, relatively strong revenue growth contributed to the year-over-year improvement in profitability. Additionally, we saw good progress in our emerging countries as they continue to expand their customer offerings while seeking to invest wisely. Moving to AWS, revenues were $24.2 billion, an increase of 13% year over year. On a quarter-over-quarter basis, we added more than $1.1 billion of revenue in AWS as customers are continuing to shift their focus towards driving innovation and bringing new workloads to the cloud. Similar to what we shared last quarter, we continue to see the diminishing impact of cost optimizations. And as these optimizations slow down, we're seeing more companies turning their attention to newer initiatives and re-accelerating existing migrations. Customers are also excited about our approach to generative AI. It's still relatively early days, but the revenues are accelerating rapidly across all 3 layers, and our approach to democratizing AI is resonating well with our customers. We have seen significant interest from our customers wanting to run generative AI applications and build large language models and foundation models, all with the privacy, reliability, and security they've grown accustomed to with AWS. AWS operating income was $7.2 billion, an increase of $2 billion year over year. Our operating margin for the quarter was 29.6%, up more than 500 basis points year over year and effectively flat on a quarter-over-quarter basis. This margin improvement reflects our headcount reductions from earlier in the year and a slowdown in the pace of hiring. Shifting to free cash flow, on a trailing 12-month basis, free cash flow adjusted for finance leases was $35.5 billion, an improvement of $48.3 billion year over year. The largest driver of the improvement in free cash flow is our increased operating income, which we are seeing across all 3 of our segments. We're also seeing improvements in working capital, notably in inventory efficiency driven by our regionalization efforts. Next, let's turn to capital investments. We define our capital investments as a combination of CapEx plus equipment finance leases. In 2023, full-year CapEx was $48.4 billion, which was down $10.2 billion year over year, primarily driven by lower spend on fulfillment and transportation. As we look forward to 2024, we anticipate CapEx to increase year over year, primarily driven by increased infrastructure CapEx to support growth of our AWS business, including additional investments in generative AI and large language models. One thing I'd like to highlight in our first quarter guidance is that we recently completed a useful life study for our servers, and we are increasing the useful life from 5 years to 6 years beginning in January 2024. We will have this anticipated benefit to our operating income of approximately $900 million in Q1, which is included in our operating income guidance. As we turn the calendar to 2024, we are excited to continue upon the great work the teams have been able to deliver in 2023. We remain focused on streamlining and prioritizing projects in an effective way that reduces costs and also allows us to continue innovating and inventing for customers. With that, let's move on to questions.
At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to ask a question, please press star one on your keypad. We ask that when you pose your question, you pick up your handset to provide optimum sound quality. Once again, to initiate a question, please press star, then one on your touch-tone telephone at this time. Please hold while we poll for questions. Thank you. Our first question comes from the line of Eric Sheridan with Goldman Sachs. Please proceed with your question.
Thank you so much for taking the questions. I'm just going to do a two-parter on AWS. If we take a step back, can you talk a little bit about the contribution from backlog conversion, AI workloads, and some elements that allowed you to re-accelerate revenue at AWS in Q4, and how we should think about those components from an exit velocity standpoint into 2024? And then against your broader comments on CapEx, any color on how we should be thinking about AI-driven CapEx within the AWS initiatives against the broader CapEx commentary? Thank you.
Yeah, that's right. This is Dave. Just to give you that figure, the balance was $155.7 billion as of 12/31. So that's up more than $45 billion year over year and $20 billion quarter over quarter.
And then, if you look back at the revenue growth, it accelerated to 13.2% in Q4, as we just mentioned. That was an acceleration. We expect accelerating trends to continue into 2024. We're excited about the continuous resumption, I guess, of migrations that companies may have put on hold during 2023 in some cases, and interest in our generative AI and products like Bedrock and Q, as Andy was describing. That on the CapEx side, let me talk in total for the company. We had $48 billion in 2023, was down $10 billion year over year. Talked about during the year quite a bit. A lot of the mix of investment in 2023 was tied to infrastructure, mostly supporting AWS, but also supporting our core Amazon businesses. Was about 60% of our spend. So it reached a very high percentage. We anticipate those trends continuing into 2024. CapEx will go up in 2024. I'm not giving a number today, but we do, and we're still working through plans for the year, but we do expect CapEx to rise as we add capacity in AWS for region expansions, but primarily the work we're doing in generative AI projects. In the fulfillment center and logistics area, I would say it's more incremental capacity at this point based on additional demand, although we are seeing some additional investments for same-day delivery sites and automation robotics. But the trend for most of the large percentage of the spend will be in infrastructure is going to continue into 2024.
Add a few things to what Brian said. I think just as it relates to the first part of the question, just the way to think about backlog conversion is just these are deals that we've signed that are long-term deals, typically with customers, and then there's some amount of time it takes where we work with those customers to migrate those workloads. And so, some of the trends that we have seen over the last quarter, first of all, I think that the lion's share of cost optimization has happened. It's not that there won't be any more or that we don't see any more, but it's just attenuated very significantly. And at the same time, what we've seen is that migrations, and this speaks to some of the backlog, migrations that were, proceeding, but maybe not at the pace that we saw before, have started to pick up again. We've also seen that a number of the deals that typically signed more quickly, but were signing more slowly in more uncertain environments. A lot of those got done in the last quarter, and you heard in my opening remarks some of the examples, but that was, some of several, and we're continuing to see that trend. And then, on the Gen AI side, it's, if you look at the Gen AI revenue we have, in absolute numbers, it's a pretty big number, but in the scheme of a $100 billion annual revenue run rate business, it's still relatively small, much smaller than what it will be in the future, where we really believe we're going to drive tens of billions of dollars of revenue over the next several years. But it's encouraging how fast it's growing, and our offering is really resonating with customers.
And the next question comes from the line of Brian Nowak with Morgan Stanley. Please proceed with your question.
Great. Thanks for taking my questions. I have two. Andy, the first one is sort of on the cost to serve comments coming down for the first time since 2018. As you sort of look into 24 and 25, can you just sort of walk us through some of the key operational blocking and tackling that has to happen to continue to drive down that cost of serve back to 2018 levels, or however you're thinking about your North Star from that perspective? And then the second one is one sort of philosophically about capital returns. It looks like the cash balance could start building pretty nicely here. How do you think about the idea of, buyback, share repurchases, or some type of capital return program to sort of help shareholders out?
Yeah, thank you, Brian. I appreciate it. I'll take the first, and I'll let Brian take the second. On the cost to serve coming down, as I mentioned in my opening remarks, I don't think that we feel like we're where we're going to ultimately be. I think we feel like we have meaningful upside there. And, I think one thing that it's easy to make as large a change as we made in regionalization in the U.S. and think, check, we got that done. But the reality is we still have several improvements and a bunch of ways that we can hone the regionalization improvements that we made in 2023 in 2024. And so when the team speaks about the areas where they believe they have opportunities, there's still opportunities just in regionalization as we continue to hone that. But I also think, in many ways, it was very useful for us to go through what was, a pretty significant change we went through during the pandemic, where we doubled the size of our fulfillment center network in 18 months and built out a last mile transportation network the size of UPS in 18 months. It was disruptive to get that optimized. But one of the things that was very useful was it really caused us to relook at everything we were doing with the fulfillment network. And we looked at it with really a beginner's eye. And we have found so many areas that we believe that we can evolve that I think will both help our cost to serve and even more importantly, deliver faster delivery speeds for customers. And I mentioned, one area which, in particular, which you'll see us focus on over the next year or two is just we think there are real opportunities in our inbound network and our inbound processes, and then where we locate inventory in association with that, which will accomplish both of those tasks. But, for us, I don't believe that we believe that 2018 is the North Star in cost to serve. I think we believe we can keep evolving it and being better than that.
Yeah, I just add a couple other items there. We've gotten a lot better at fixed cost controls as we scale, and I think you're seeing that as part of our ability to lower cost per serve. It's not only in operations; it's actually throughout the company. And we're seeing a reduction in some of the inflationary factors that hit us in especially hard in 2021 and 2022. Things like transportation services, fuel, and others. So not totally out of the woods there, but coming down, and we still see some more upside. On your share repurchase question, first of all, I'm just really excited to actually have that question. No one's asked me that in 3 years, and appreciate it. But we have come through a tumultuous period where, as Andy just said, we doubled the size of our logistics footprint and invested heavily, and you saw that in negative free cash flow, at least on our Alt-2 calculation for the period 2021 to 2022. So we're glad to see the improvement and the bounce back in free cash flow. And we do debate and discuss capital structure policies annually or more often. And I have nothing to announce today, but again, we primarily think we have a lot of strong investments in front of us. We're glad to have the liquidity better liquidity at the end of 2023, and we're going to try to continue to build that.
And our next question comes from the line of Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks for taking the questions. Brian, you've seen very good improvement in international profitability over the last several quarters. Can you just talk about some of the levers here that you're thinking about just as you look to move into positive operating income, and then how international could potentially approach North America levels over time? And then just a follow-up there, are you seeing any shipping disruptions currently related to the Red Sea, and does that factor into your outlook at all for 1Q? Thanks.
Yeah, let me start with the second one first. So we're mindful of the geopolitical issues around the world, especially as you say in the supply chain, and how that might impact shipments both to the U.S. and to Europe. We're just working very hard to make that not back up on customers, and we'll continue to work that. It's not a material impact into the estimated in our guidance in Q1. But again, as I said, we're vigilant on that, and we'll work to take steps where we need to make sure that the customer experience is not impacted. On the international segment operating income, we're very pleased with the results, especially over the last few quarters. We improved operating income by $1.8 billion year over year. And I would attribute it to the steady progress that Andy was saying about the U.S. Yes, again, cost of service down, advertising is stronger, a lot of attention to cost, a lot of attention to investments and where we're going to invest, and other fixed cost controls. So a lot of that is what we're seeing in the established countries of Europe and Japan. I would divide the segment a bit into a couple buckets. First, there's that international segment, European established country segment, and that's it behaves a lot like you would see in North America. If you look at the emerging countries, and we've launched 10 countries in the last 7 years, they're all on their own trajectory of journey to profitability and significance with customers, and we're pleased with that. I think they're all growing nicely, and again, leveraging their cost structure, investing wisely in Prime benefits, but all on a curve to break even and then be a contributor to income and free cash flow. The other thing I'd point out is that we have advanced loaded, I would say, Prime benefits in our international markets. We think it's a very good source of customer acquisition and customer retention. The investment in those areas can fluctuate quarter to quarter. We had a bit of a higher spend in digital content in Q4, as we had a number of marketing and content, especially around live sports, English Premier League and Champions League in Germany and Italy, for example. But we like those benefits and those investments. They're a proven vehicle for customer acquisition, as I said, and it gets people shopping on our sites, and engaging with benefits is always positive for the relationship with Amazon.
And the next question comes from the line of Mark Mahaney with Evercore ISI. Please proceed with your question.
Okay, thanks. Two questions, please. I think you mentioned, Brian, that North American margins have improved for 7 quarters in a row or something like that, a significant number. I would assume that most of the factors like rising capacity utilization, given your CapEx commentary about retail, the regional center efficiencies, and then overall, moderation in shipping and logistics costs, labor costs. I mean, all of these factors probably mean that we'll continue to get an improvement in North American margins, but if you would comment on that. And then secondly, on the Primetime Video, Amazon Prime Video, I know it just launched, but could you provide any color context on expectations around that? You've got a massive number of Prime users. You're coming in with a reasonable, CPM with low ad load, but it seems like there should be a substantial opportunity for you. So if you want to try to size that for us, or how you think about the upside, that'd be really appreciated. Thank you.
Sure, Mark. Thank you. I think Andy laid it out pretty well a few minutes ago on the cost structure, the regionalization, the growing into the assets that we added during the pandemic, great efficiency and work with productivity across really all of our operations network, attention to fixed costs and lowering costs where we can, maintaining costs where we can, the increase in advertising, success in advertising revenue growth that's outpaced our traffic growth rates. So all of those trends we expect to continue, and we're going to work hard to make sure they continue. And as we said, we have one guidepost is maybe pre-pandemic profitability, but we are working to. We're not putting a limit on our improvement. We're going to continue to look for ways to lower the cost to serve, and I might add at the same time, increase the customer experience, because we did that. We had that cost improvement at the same time when we at first got back to our shipping speeds from pre-pandemic and then exceeded them. So we're happy with that, and we'll continue to do both to improve the customer experience and also to lower our cost and leverage our cost structure. Your second question on ads. I can't scale it right now. I mean, what I would say for ads in video is that advertisers are excited to access our Prime customer base. We're looking for ways to increase our advertising in our streaming properties, including Fire TV, but also and Prime Video, but also things like Freevee and Twitch. And it's an important part of the total business model, and we expect it'll allow us to have a healthy business, to continue to invest in content, and to continue to grow that. And we feel good about it, and we the way we anticipate the ads progressing, we will not have heavy ad loads relative to what you may see other in network TV and other things. And like all of our advertising, we're trying to get useful for customers.
And our next question comes from the line of Scott Devitt with Wedbush Securities. Please proceed with your question.
Hi, thanks. I have one on grocery and one on healthcare. First, on grocery, I was wondering if you could talk a bit about the progress that you're making in unifying the offering between .com, Fresh, and Whole Foods, and as it relates to reverse logistics and using the grocery facilities, how that's lowering the cost of reverse logistics, and whether there's a significant opportunity there in terms of driving traffic and revenue in the grocery business. Then secondly, on healthcare, it's such a notoriously poor customer experience industry. And, you've made pretty significant efforts now with an acquisition and offering primary care. I'd just be curious if you could talk a little bit more about the longer term vision in healthcare. Thank you.
Yeah, on grocery, we're pleased with the progress we're making there. We always think about our grocery business right now in kind of, I'll call it, three big macro segments. The first is non-perishables, where these are things like consumables and canned goods and pet food and health and beauty products and pharmaceutical. And it's a big business, and it's continuing to grow at a very healthy clip, and we're really pleased with that business. And it's really the way that most mass merchandisers got into the grocery business, a few decades ago. So that continues to grow at a very healthy clip. We have a physical presence, along with online, but in Whole Foods Market, which is really the pioneer and the leader in organic grocery, and that's continuing to grow at a very good clip. We also made a number of changes in the business last year on the profitability side, where we really like the profitability trajectory we see there. And so, again, you'll see that keep growing and expanding, and feel very good about that as well. If you want to serve as many grocery needs as we do, you have to have a mass physical presence, and that's what we've been trying to do with Fresh over several years. We've been testing a V2 of our Fresh format in a few locations near Chicago and a few locations in Southern California. It's very early; it's just a few months in, but the results so far are very promising, and on almost every dimension. And so, we need to see it for a little bit longer time, but the results appear like we have something that's resonating. And if we continue to see that, then the issue becomes how fast and what's the best way to expand. We have also been spending increasing amounts of time and efforts here trying to make it easier for customers to be able to shop between, the non-perishables and then our selection in whole foods as well as fresh. I think you can expect to see that over time, both in the user experience, on the app and on the website, as well as how we're able to better leverage between the different business segments and their logistics capabilities, being able to get better leverage there, better economics, and then allowing people to order in one concerted place, but be able to pick up from multiple types of grocery products in one place. You're seeing us already do more of that, and I think you can expect that in the future. In the healthcare space, if you think about what we do on the retail side, adding a pharmacy capability is a pretty natural extension. It's something that customers had asked us for many years, and it's got more complexity to it than the rest of our retail business. So we had to think carefully about whether we wanted to pursue it, but customers so badly wanted it, and the experience we thought could be better, and we could be a meaningful part of changing that we pursued it. And I really like the momentum that we're seeing in our Amazon pharmacy business. It's growing really quickly, but even more important than how fast it's growing, if you've used it and you've paid attention to the customer experience over the last 12 to 15 months, it's just substantially improved from where it already was pretty good. It's, people really love the experience. And I think that when, the healthcare experience, particularly in the U.S., is a pretty frustrating one and not a very good one. And I think that when we tell our grandkids that the way you used to have to go get primary care was to make an appointment 3 weeks in advance and then drive 20 minutes to the doctor, park, wait in the reception for 15 minutes, get put into an exam room for 15 minutes, doctor comes in, talks to you for 5 to 10 minutes, and then you got to drive 20 minutes to the pharmacy. People are just not, our grandkids will not believe that was the experience. And it's not going to be, and you already see that changing. And it's part of what attracted us in such a significant way to One Medical is just their application, their app is so easy to use. You have all your healthcare data in one spot. You can do chats with medical practitioners. You can do video calls. If you need to see someone, there's physical locations in lots of metropolitan cities where you can get in the same day. If you need to see a specialist, they're plugged into specialists in all the cities in which we operate where you can get in a day or two later. Like it's a very different experience. Now, if you actually need medication, you can get that sent to you in a day or two, either through Amazon Pharmacy or other pharmacies that we work with. And that experience is so much better than what we've been accustomed to seeing. And so I think it's, again, still early days. We're excited. We launched for Prime members the ability to get a One Medical subscription for $9 a month or $99 a year, which is 50% off the typical price. And that saw a very good take up. So it's still early days, but we think we have an opportunity to be a meaningful part of changing that experience. And if we are helpful in changing what that primary care experience is and what it looks like to get pharmaceutical items, there's a lot of other things that we might be able to help customers with over time. That, whether it's wellness or whether it's diet, there's a bunch of areas that I think we can help over time.
And our final question will come from the line of Colin Sebastian with Baird. Please proceed with your question.
Thanks very much. I just wanted to follow up on AWS for a moment. You outlined the generative AI stack, which I think is very clear. So I'm just curious, maybe how you're going to market within the application layer, given sort of the competitive dynamics of that, and then maybe expand, if you could, Andy, a little bit on the strategy for Gen AI on the consumer-facing side of the business. I know you launched Rufus today. Is that an area that you think could materially improve conversion rates and the overall consumer engagement on the retail apps, or what's your vision there? Thank you.
Yeah. So, Colin, I would say a few things on first on generative AI. It's when we talk to customers, particularly at enterprises, as they're thinking about generative AI, many are still thinking through at which layers of those 3 layers of the stack I laid out that they want to operate in. And we predict that most companies will operate in at least two of them. But I also think, even though it may not be the case early on, I think many of the technically capable companies will operate at all three. They will build their own models, they will leverage existing models from us, and then they're going to build apps. And I know one of the other interesting things that we see early on right now in generative AI is that it's a very iterative process and real work to go from plugging a question into a chat bot and getting an answer to turning that into a production quality application at the quality you need for your customer experience and your reputation. And then also getting that application to work at the latency and cost characteristics that you need. And so what we see is that customers want choice. They don't want just one model to rule the world. They want different models for different applications. And they want to experiment with all different sized models because they yield different cost structures and different latency characteristics. And so Bedrock is really resonating with customers. They know they want to change all these variables and try and experiment. And they have something that manages all those different transitions and changes so they can figure out what works best for them, especially in the first couple of years where they're learning how to build successful generative AI applications is incredibly important to them. So it's part of why we see Bedrock resonating so much. In the same way, what's attractive to enterprises when they think about coding companions like Q is just if you can get 30-40% better productivity for your developers, which in many cases for companies is their most scarce resource, it's a game changer. And and they won't roll out every bit of code that comes from a coding companion, but if it can assist them to get 80% plus the way there quickly, that's a big deal. And one of the things that's unique about Q is it's not just a coding companion. Yes, it's an expert on AWS. It will help you, it helps you write the code, but it also helps you debug the code and helps you test the code and it helps you do transformations and it helps you figure out how to multi-step implement features. There's a lot of, it helps you troubleshoot. If there's something in your application that's awry, Q can find it and help you fix it. And so, and then it also lets you look at all your data repositories, whether it's intranets or wikis or the 40 plus data connectors like Salesforce and Atlassian and Zendesk and Slack, and it lets you have an intelligent conversation to get answers and take action. So it's a pretty differentiated capability there. And when enterprises are looking at how they might best make their developers more productive, they're looking at what's the array of capabilities in these different coding companion options they have. And so we're spending a lot of time, our enterprises are quite excited about it. It created a meaningful stir at reInvent. And what you see typically is that these companies experiment with different options they have and they make decisions for their employee base. And we're seeing very good momentum there. The question about how we're thinking about Gen AI in our consumer businesses, we're building dozens of generative AI applications across the company. Every business that we have has multiple generative AI applications that they're building. And they're all in different stages, many of which have launched and others of which are in development. So if you just look at some of our consumer businesses, on the retail side, we built a generative AI application that allowed customers to look at a summary of customer reviews so that they didn't have to read hundreds and sometimes thousands of reviews to get a sense for what people like or dislike about a product. We launched a generative AI application that allows customers to quickly be able to predict what kind of fit they'd have for different apparel items. We built a generative application that in our fulfillment centers that forecasts how much inventory we need in each particular fulfillment center. And so the start of the rollout of Rufus today is really just another step, but we think one that's pretty meaningful in being a generative AI powered shopping assistant. And it's trained on our very expansive product catalog as well as our community Q&As and customer reviews and the broader web. But it lets customers discover items in a very different way than they have been able to on e-commerce websites. So if you want buying advice, like what should I look for in a pair of headphones, or if you are doing purpose buying, like what should I buy for cold weather golf, or comparisons, what's the difference between lip gloss or lip oil, or you want recommendations on the best Valentine's Day gifts, or you're on a detail page with rich product info where you don't want to go through the whole page. You want to ask, is this pickleball racket good for beginners? All those questions you can plug in and get really good answers. And then it's seamlessly integrated in the Amazon experience that customers are used to and love to be able to take action. So, I think that's just the next iteration. I think it's going to meaningfully change what discovery looks like for our shopping experience and for our customers. And I could kind of step through every one of those consumer businesses. Our advertising business is building capabilities where people can submit a picture and an ad copy is written, and the other way around. And you can kind of think about Alexa, where we're building a very large, expansive large language model that's going to make Alexa even more productive and helpful for customers. Every one of our consumer businesses has a significant number of generative AI applications that they either have built and delivered, or they're in the process of building. And I don't see that. I don't see that changing for many years. We have a lot of ideas.
Thanks for joining us today on the call and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon, and we look forward to talking with you again next quarter.
And ladies and gentlemen, that does conclude today's teleconference. You may disconnect.
All right, folks, that is the end of I just tweeted, Chris. I just tweeted Jassie's those last 5 minutes. I mean, goodness gracious. I think Amazon is the one out of the Mag 7 that knows what the hell they're doing when it comes to AI. I mean, Jassy is killing this earnings call and explaining how AI is going to affect every single part of Amazon's business: grocery, advertising, shopping, AWS. To me, that was single-handedly the best earnings call I've heard across the big 7. I haven't listened to Apple's yet, but from Microsoft, Google, Meta, or Amazon, that last question, Jassy spent a good 5 minutes talking about what AI means for operationalizing the entire business to get on board with AI, to get on board with advertising, to get on board with driving consumer relationships, the stuff they're talking about in terms of the intimacy of shopping at a Whole Foods and what that means for consumer recommendations and the personalization of that. I mean, there's going to be either incremental operating margins or just increased efficiency throughout the entirety of the organization, which should drive shareholder returns over the next 5 years based on AI affecting all the consumer parts of their business, not to mention the enterprise parts of their business like AWS. So that was incredible. That was a massive call. That was very, very good. I don't have an Amazon position, but I mean, hell, if out of all the calls I heard, even above Meta, Amazon would be the one that I would be a little excited more to buy. Now it's up 6.9%. I do want to say Meta's up still 14%. Amazon's up 6%. We'll see what happens tomorrow. You guys got to remember that, and I have to remember constantly, that things look great when they go up, but we are at all-time highs on these stocks. We are at all-time highs on the indices. And this is only 4 weeks into the year. We have gotten a year's worth of returns in many of these stocks within 4 trading weeks. S&P 500 is up almost 4% for the year. So it's going to be interesting to see how this plays out. I think if you miss the run-up in some of these stocks, there may be an opportunity in the next couple months to get in at maybe cheaper prices than today, maybe cheaper prices than they were, a couple weeks ago, based on just the market cycle, based on inflation, all that stuff. But that's more of the bearish case. The bull case is that inflation is coming down. J-Pound knows inflation is coming down. Trueflation put out a great report today. We'll go through that tomorrow in the market open, that, deflation seems like it's here, which means once that happens and once the Fed cuts rates, maybe 450 is cheap for Meta. Maybe 170 is cheap for Amazon. I mean, it's going to be a really interesting next 6 months to see what this looks like. As Matt says, Amazon is a stock you can hold forever. I agree. And, if you don't have a massive Amazon position and wanted to start DCAing into it, 170 is close to all-time highs at 180, but it also doesn't feel like, based on this call, you're massively overpaying. Now, for Microsoft, it kind of feels like you're paying a little bit too much, because I didn't feel, at least, the insane level of momentum and growth that Microsoft can have. Yes, Azure Cloud's growing at 30%, but What Amazon just described are businesses that are in their infancies in terms of advertising at only 14 billion, subscriptions at 10 billion. AWS, not in its infancy, but AWS having plenty of room to expand. They only made $5 billion off of Whole Foods. How much better can that get? And how much better can the margins, more importantly, get on that as they expand AI throughout, all parts of the enterprise? So Amazon absolutely killed it. Incredible earnings and really exciting stuff for Amazon. Now, let's quickly talk Apple, and then we'll discuss Meta. So Apple is down for two major reasons. Number one, their China sales declined enough for, I think, the market to be like, well, wait a second, what's going on here and why is it down? As you can see right here, the North American sales barely went up and China came down about 3 billion. So that wasn't good for Apple. They did, 23 billion last year, 20 billion this year. The other thing is on the earnings call, they guided for 90 billion in revenue. They did 119 this quarter. So yes, they're going to guide lower because it's not a holiday quarter, but that's $29 billion, if I'm not wrong. Yeah, 29 billion less in quarter over quarter growth when it comes to guidance. Apple right now down about 3.2%. It's not like that's the worst thing, but it's not the best thing. I mean, that's for sure. It's definitely not something that's going to get the market super excited. Let me just pull this up right here. I just want to show you guys one thing on the Apple earnings, and then we'll talk about Meta. The other thing I saw on Apple was the services growth. So I'm trying to pull it up, but the services growth came in good, not great, which I think has the market also thinking like, how do we interpret this business? And as a result of that, you kind of just don't know what to do with Apple right now, given it's trading at a 28 PE and you don't have, a ton of growth that's getting up there. Oh, here it is. Consolidated financial statements. Okay, this is what I want to show you guys real quick. So this is Apple, and then we'll get into Meta. So this right here, services was 23 billion. Products was 96 billion. So 119 billion in total. Last year, services at this time was 20 billion. This year, it's at 23 billion. So services is up 3 billion, which is nice. As you can see, products is barely up, right, year over year. It's negligible. It's like literally nothing. So without this 3 billion increase in services, they would have zero growth year over year, right? Last year they did 117 billion. This year they did 119 billion. It's, maybe Apple needs to raise the dividend to attract investors. I mean, they have to prove that there's real growth. I haven't heard the earnings call, but the guidance wasn't amazing and the growth is not there. So investors have to be willing to bet that the Vision Pro or services is eventually going to grow. I don't see the services growth right now. I mean, it doesn't seem insane. So not really sure how you would justify Apple long term. And so we'll see what happens from there. Can you guys talk about this during FJ? Yeah, we'll be discussing everything on Finance Junkies tonight. We'll be breaking this down as well. Vitaly will definitely show up tonight. I can say that, given what Meta's doing. Vitaly will definitely show up tonight. We'll talk about regional banks. Yes, we'll discuss regionals. TFC had a nice V-shaped recovery today, even though regionals suffered, and there's a reason for that. So we'll talk about that as well. Okay, so that was Amazon. That was Apple. Let's finally discuss Meta. Meta stock price right now is still up 14%. Street has not sold it off, and there's no reason to. $450. The reason it's up right now is because they're doing $50 billion of buybacks. They have $80 billion now that they're authorized to do in terms of buybacks. They are giving a 50-cent dividend, $2 a year, which doesn't sound like a lot, but if institutional investors that have millions of Meta shares, they get to sit back and do nothing and just watch their shares not only go up in value based on the guidance, but also a free 50 cents every quarter, $2 every year for every share. That's not the worst thing in the world, dude. I mean, that's going to keep you owning those damn shares. So maybe for retail investors, it's not incredible, but for institutional investors, it's definitely a reason to keep owning the stock. And then they have almost 4 billion people using the product every day. Chris posted something about Reels monetization continuing to go higher. Maybe, Google missed on their advertising because more advertisers were going to Reels. Obviously, Google missed by a negligible amount, but Reels is working. AI is empowering Reels to be better. Remember, the bull case for Meta is that they've invested so much in their AI infrastructure that now the recommendation engine around the discovery of stories, Reels, Instagram photos, products and services on the Facebook app, et cetera, has become so supreme, so phenomenal. I mean, from an anecdotal experience, my mom, buys something off Instagram every month, and she knows when it's an ad. Like we were talking about it yesterday. She knows when it's an ad. She'll click on it with the intent to buy, given she knows Facebook's trying to, it's gotten to the point where my mom has a relationship with Instagram that she's asking Instagram kind of, without literally asking, for product recommendations, almost as if it's Amazon, right? Because she knows something good will pop up and I'll be able to check out a good product or service. So I would imagine that millions of billions of people across the world have somewhat of a same relationship like that, even if it's not as explicit. And that's just fueling the advertising spend, because that means people are actually buying products off of Amazon or off of Meta, Instagram, Facebook. And that's leading to better discovery, better monetization, et cetera. Now, the one thing I want to harp on here on Meta was that WhatsApp monetization is starting to begin. They talked a little bit about that on the earnings call. That's going to be massive. During the World Cup, WhatsApp had 25,000 messages sent a second. Okay, WhatsApp is huge. WhatsApp is massive. So I believe WhatsApp is going to be incredibly important for Facebook, and the monetization of that is just going to get bigger and bigger and bigger. Dude, people aren't leaving WhatsApp. That's not happening. People aren't leaving Instagram, to the best of my knowledge. TikTok can barely keep their music on the platform. So TikTok is absolutely not a threat. And then Facebook, even though, I actually have a Facebook group. Let me put it in the chat. Let me plug this right now. I have a Palantir Investor Facebook group that has almost 2,000 people. Okay. So yeah, I don't use Facebook that much, but I'm starting to post more in that group. I'm going to put it in the chat right now. So if you're on Facebook and you use it, sign up to that group. It's free. And so you can, there are a decent amount of people that check my Palantir updates on that group. Right. And as a result of that, there is momentum to Facebook, is what I'm trying to say. So I think when Zucks was talking about Reels discovery, monetization, et cetera, the other big part of what he said was how AI is going to play a role in everyone's life. Very similar to what Jassy was saying. So what I got from there is that Zucks is basically saying AI is going to play a role in every single person's life, whether you're a creator. He said AI will allow you to be able to interact with your audience. I think he's talking about custom-built LLMs for your content. Like you can literally talk to your favorite creator, almost like a GPT type of thing. He talked about it in the context of consumers, right? If they want to buy something, if they want to search for something, they can use Meta's Llama as the infrastructure for AI, as that's integrated into WhatsApp. I got access to that a couple of days ago. And then obviously for advertisers, they're going to be able to use AI to massively increase their advertising spend. So, it's really, really, really exciting. Chris, I'll show your DD in a second on Patreon. It's really, really exciting for what Amazon is trying to do, what Facebook is trying to do, and ultimately what we're living in. What's really crazy is you got Arc Innovation saying Roku, Zoom, and Teladoc are going to be the most innovative companies in the world. The big seven, the companies that were deemed as boring and old, these are the companies that, first of all, without their earnings growth, the S&P would be negative. But second of all, it seems only right that these are the companies that are innovating in the space, because they have all the infrastructure from an R&D perspective and the just piles of cash to subsidize all the research they're doing. And if they have all this cash that they can use to subsidize their research, they're going to win. They're not going to lose. This is not something you bet against, even at these prices. Now, maybe these are not the best prices given they're at all-time highs, but these are companies I think for the next 5 years, maybe you don't bet on Roku. Maybe you bet on Amazon, right? Maybe this is kind of how things go. Let me give a shout out to Chris and his Patreon right here. This is some of the DD that he's posted right here. I'm just going to post his Patreon in the chat. I think it's like $10 a month. So for those that want to join a really good community of people, definitely recommend checking that out. He just published Celsius DD last night, which is why I've started to get a little bit more bullish on Celsius, even though this pineapple flavor is garbage. So first day of DD on my, on the ground, it's not good. I don't like it, but I can't deny that a lot of girls on TikTok for some reason drink this. So you guys can check out that Celsius DD. So again, we're seeing a lot of things on Amazon where they're just increasing their margins, decreasing their CapEx. Amazon Prime continuing to grow. Subscriptions was 10 billion this quarter. That was amazing. Countries are 25 different countries using Amazon Prime. This was their Q3 full year 2023 statement. Let's see if I can pull this up on Twitter. They probably have Q4 ready to go. But there's a lot of due diligence on Amazon being essentially I don't want to say monopoly, but a pseudo monopoly in e-commerce. I know there's a lot of e-commerce players. There's the Shopifys of the world, but no one's giving you the traffic that Amazon is doing. And that monopoly increasing its margins, which over the next 3 years, you would imagine with operational efficiencies, things like last mile delivery and just making their vehicles more electric and easier to be able to drive to deliver that package to the customer. There's just so many things that are going to happen to make Amazon continue to go higher. And Andy Jassy is someone you want to bet on. Andy Jassy is someone you want to bet on. Jassy and that earnings call, the last 5 minutes, I mean, I would recommend everyone listen to it again. Just incredible, dude. Just incredible to hear him talk the way he talked. He sounded like he had a vision. Sundar did not sound like he had a vision for AI. Zuck sounded like he had a vision, a real vision, even if it's, integrated solely within the Meta universe. Jassy sounded like he had a vision about how Amazon customers are going to use it in their day-to-day lives and how they interact with Amazon. Satya Nadella had a vision for, even though Microsoft's not as consumer-facing, what the enterprise is going to do with AI. Lisa Su has a vision for it. Jensen Huang has a vision for it. Sundar didn't really sound like he had a damn vision for it outside of AI ads, which, quite frankly, what else is he going to say? Because 95% of the revenue on Google is advertising. So, I think Google is still the best, one of the big seven, because the valuation is, to me, is starting to get stupid. But maybe this year they're going to take some time to develop and really get set for stage, unless maybe they offer a dividend. Right? Maybe they could play out of Zuck's playbook. Maybe they actually incentivize shareholders to want to own the stock a little more. I don't know what they're going to have to do, but this AI revolution is here. And so far, it doesn't really feel like Google has caught on and made it very apparent that they are going to play a role here. Now, granted, I think the stock selling off 8-10% is kind of stupid and ridiculous. So I think it'll be back. But the rest of these companies have killed these earnings. The rest of these companies absolutely killed these earnings, and they deserve to kill these earnings. So that's what we got. That's what we got. Next thing you know, you'll live stream all your article writing, LOL, given you show us your live tweets. I just watch your 24/7 live streams. Michael, I appreciate that. It means the world to me. Thank you, everybody, for joining. This was a really, really fun one. Look, regardless of if you're in these stocks or not, I know people tend to get a lot of FOMO if they're not in these positions and they see this money go up. Two things. Number one, it's okay for other people to make money. This is the stock market. This is capitalism. This is not the Delaware court judge that hates people making money. This is a community of people that want other people to win. So, if you see me, whenever someone makes money, whether it's on whatever stock it is, I'm just excited because I want people to win in the stock market. Why do I want people to win in the stock market? Because I know that if we build a community of people that are excited and happy for other people, then this is going to become one of the best communities on the internet between the Twitter and the YouTube account. And people are going to win. People are going to do very well. And people are going to post more DD and collaborate and crowdsource and try to help other people find different opportunities. So I think regardless of if you're in these stocks or not, you deserve to win. You deserve to make money. And you should be very excited for other people making money. Number two, everyone can benefit from the broader stock market doing well if the big companies do well. Apple going down 3% today is not good for the stock market. Meta and Amazon going up 7-10% is very good for the stock market. It means there's more liquidity entering. It means that people want to buy, and it means the trillions of dollars that have not played in the big boys yet, that they're stuck in those money market funds. They're looking at 10-20% gains in a day, and they're like, wait a second, why the fuck am I getting 5%? Like, why am I not participating in some of those most innovative and exciting companies in the world? Why is my capital not compounding here? Why am I not, why am I not allowing my money to really grow by taking a little bit of risk on companies that are just performing phenomenally? Why is it sitting here collecting dust? And as the Fed lowers rates, that money is going to be looking for a better return. And so you want Meta to go up 14%. You don't want Meta to go up 2 or 3% because you could get better gains sitting in the money market funds. So overall, this is very good for the stock market, very good for the broader economy. And now, as long as the macro holds up, inflation comes down, interest rates come down, 24 is going to be a phenomenal year. And it's going to be super, super, super exciting to see how this happens. Chris says this year you better be ready for a Vegas meetup. Vegas is going to be fun. Vegas is going to be very, very fun. Garcia says the stock market's like craps. I want everyone to win. Yeah, that's a good point. I learned about craps when I was at Vegas. Garcia was the one teaching me here at Vegas. He was like, yeah, everyone's supposed to win. I was like, oh, cool. So this is not, this is not super competitive. Everyone's trying to make some money there. I think that's the stock market. The whole market goes up. Everybody does well. Really, no matter what sector you're in, outside of crypto, the broader market does well. Most stocks are going to go up. So the next earnings that I'm excited for are PayPal, Robinhood. That's going to be a big one for me. And then obviously Big Daddy on Monday, Palantir. I have no earnings play on Palantir. I am purely just waiting to see what happens. I think if guidance comes in at 25%, it's going to be a very good earnings. I think if guidance comes in at 20 to 22%, it'll be an okay earnings. And if guidance comes in below 20%, it'll be a bad earnings. I don't think it'll be a bad earnings. I think it'll be a good earnings. And I think management will have a strategic guideline or a roadmap for what they're going to do with AIP, the government business, etc. So going to be really excited for that. Robinhood, I'm going to be very excited for as well. I've been talking to a lot of people, dude, just on the ground DD I've been doing for Robinhood. And I don't know if I'm going to be right about it, but I think they're going to have a good earnings. I think they're going to smash. And I think even if it sells off, which a lot of these companies are going to sell off a little bit, I think Robinhood's going to do well. PayPal, I have no clue. Absolutely no clue. We might get our world shocked or we might not. So we'll see what happens, but it's going to be an exciting couple weeks left on this channel to discuss Robinhood. Jurin AK, thank you for being here as well. You're joining on the live stream. This is a new account that I just recently followed on Twitter and recently followed me, and she's super into Robinhood. I was like, hey, check out Robinhood. And she's like, all right, I got a position in Robinhood. So I think a lot of people that are looking at the numbers and the valuation are just like, this doesn't make sense. And maybe we get a little bit of a Meta surprise. Maybe we get a little Amazon surprise. Maybe we see a 10, 15% on earnings. I don't know. But in general, I'm pretty bullish on Robinhood and Palantir, and we'll see what happens from there. So super exciting. SoFi has crashed after their earnings. SoFi right now is at 783. It's up about 1.42%. It's down from 945. So SoFi shareholders are just going to have to keep holding on to the stock and, hoping something happens. But I don't know about SoFi. The market doesn't like SoFi. Maybe the market doesn't like fintech. We'll see what happens. We have a broader rally. SoFi should, get to that $9, $10 range to hopefully sustain it. If not, the one reason SoFi is down is because their estimates for net income are disgusting. The street is saying, people are saying they're sandbagging. That's okay. But then you can't blame analysts for giving you an $8, $6 price target if your net income estimates are like unchanged for all of 2024. They're not showing any growth on their EPS. So, okay, you can be sandbagging, but if you're not sandbagging, you can't really get mad at the analysts for saying that, that we can't upgrade the stock price if the EPS isn't growing. So we'll see what happens over the next couple of weeks as we round out earnings season as well. Thank you, everybody, for joining. We got a ton of more companies to cover over the next couple of weeks. Really appreciate you guys joining this community, being part of it. You guys could have gone to a lot of places to stream these calls and be with someone. I'm very, very grateful from the bottom of my heart. You guys chose me. I do not sell a course on this channel. I don't really sell anything. I'm just happy to be here, happy to keep building. And we're in the early stages of this channel as well in terms of its growth trajectory. And hopefully over the next 2-3 years, we can have Meta-like levels of growth one day as we keep going. So thank you, everybody. Appreciate it. Hope you guys enjoy. Have some good food tonight. If you got some gains, congratulate yourself, because most people don't invest in the stock market. And if you invest and you're lucky enough to have some gains because you picked on the right company, you deserve to celebrate that. Most Americans, most people around the world don't even know what the stock market is, don't know what it means to invest. They're watching Stranger Things on Netflix versus realizing they could be investing in Netflix. So if you're investing in general, give yourself a pat on the back and let's keep it going from there. I did get the Celsius and it sucked. I have 2 more flavors. I'll be drinking one on the market close tomorrow and then one more on the market close on Monday. So I'll spread it out over the next 2 market closes. But this pineapple one, this did not taste good. I couldn't even finish it. Did not taste that good. But we'll give it 2 more chances. We'll keep it going. All right, everybody. Have a great night. I'll see you on Finance Junkies at 9 p.m. recapping everything. We'll see if we can get Steve on. And then we'll be back tomorrow, 8:45 a.m. for the market open. Thank you, everybody. Have a good one. Good night.